really the last 2 months defined 2023 markets.
I think we're going to see more money flow into the equity markets simply because those yields are going to keep coming down.
We're normalizing something else, but the big shock and all are behind us.
I think you're seeing these rolling recessions, with different sectors doing poorly in different environments. And I think that continues in 24.
2024 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
A lot of talk about 2024, but before we get there, could we see a new all-time high on the S&P 500 in 2023? Everybody, we are super close. A very good morning from New York City for our audiences worldwide. This is Bloomberg Surveillance live on Bloomberg TV alongside Manus, Cranny, and Katie Greifeld. I'm Carol Massar. Keep in mind, though, we are also watching oil very closely, backing off about 0.7%. We want to get to the market boards for you. It is coming after a 2.7% gain yesterday as we continue to be concerned about escalation in the Middle East. There's a lot going on. Let's bring in the team. Once again, I feel like, we expect it to be a little bit of a quiet day, but the themes from yesterday continue, Katie.
Big time. You do see oil taking a little bit of a breather, down 0.7% or so, but that was after a pretty dramatic Tuesday that we saw yesterday. Manus, I know we were asking the question about what was going to wake oil up. I mean, what a slide it has been since mid-October or so, but it seems like some geopolitical premium finally coming in.
I'm surprised that 6% is all that we got in terms of the repricing of war. And I think in the past 24 hours, yes, we've discussed the attacks in the Red Sea. We've discussed the U.S. approach to Iraq. But I think the overnight news is about the conversations between Joe Biden and the Qataris, Amir Sheikh Tamim bin Hamad Al Thani. And this is about hostage release. This is about pushing the political narrative forward. There's an urgent effort to secure the release of all remaining hostages held by Hamas. And again, this goes back to the push forward on politics as the reality on the ground is becoming more heightened.
Yeah, it's a tough one, and it's hard to see maybe how this ends. No one wants an escalation, but, I was reading a lot, we all were reading a lot, trying to make sense of it because it just feels like there's a lot of moves going on, trying to figure out what means something significant in a move towards escalation. You've got a lot of non-state groups that we're trying to keep track of. That's what makes this such a complicated situation for the world. There's an unpredictability of what Israel might do and the military might do, and then what Iran might do in terms of responses, Katie. It makes it a very complicated situation to figure out, does it get worse or could we find some kind of solution here? Yeah,
that escalation that no one wants into a wider conflict. Obviously, it seems like that is what we're moving towards. But really, this week, the last trading week of the year, this really seems to be the conversation to have because you take a look at markets and they're so quiet, as you would expect on December 27th. So obviously, geopolitics in focus, and as a result, what we're seeing in commodities.
Stocks, right? Hitting a record yesterday at 1.8%. It is up 66% year to date. I know. I hate to be a little irrationally exuberant, but it's hard to not ignore some of the bounces that we got from late October.
I think I can only afford one more catatonic moment in equity markets before that sort of sunset of my career.
Because he says guitar so well.
Could you just say that?
But on a slightly more serious note, the European bond markets are catching up. Just look at the drop in UK yields, down by 9 basis points at the very short end of the curve. Hugely successful auction here yesterday on the 52-week, the one-year paper. Right. Very much gorged upon by the bidders. So UK yields are dropping. German bonds are dropping by 5 basis points. So again, there's this catch-up trade in Europe as it wakens up from an extra day off. Those Europeans, more holidays.
It's a reminder. They always have holidays. It's the only
Boxing Day. Have we figured out what that is?
What is it?
It's called living.
Okay.
We don't know how to do that. All we do is work in the United States. Having said that, it's a reminder from the guest we had yesterday about it being a global bond story. And we have to be watching what global central banks are doing. I do think about the cumulative effect of central banks, essentially, of what we get next year in terms of, possibly a very aggressive easing environment, Katie.
Also a nice reminder that there are still Treasury auctions this week. Corporate America got the message, don't report earnings on this week, but the Treasury Department's still selling bonds.
You know how we get the week ahead and we're looking for the economic reports? it was just about a few auctions.
There we go. We can always rely on the Treasury Department.
Do we want to show the markets? Did we do that already, guys?
We can do it again.
It's a little
You're front running yourself, Carol?
I am. You know, I'm trying to keep track of it all. New York crude, as we said, down about 0.6%, 75.09 a barrel, 48.24.25. The number we're watching on the S&P, all-time high of 47.96. That was January 3rd of 2022. Could we get it? We're pretty quiet this morning, and that 10-year 3.87. That is a great setup and backdrop for our next guest. Steve Sosnick is with us, Chief Strategist at Interactive Brokers, joining us on this Wednesday. Happy holidays, almost Happy New Year. Steve Sosnick, when you look back at 2023, how do you think about the year? What did you miss? What do you wish you had thought about differently?
Good morning, Carol, and good morning, everyone. The thing that I think I missed, and along with many others, was we had the year sort of. The pain trade caught up to everybody. The pain trade was that we would rally dramatically in spite of monetary tightening, in spite of a banking crisis that we did avert. And I think this rally that we're seeing now, was sort of the pain trade in evidence. I've been calling it weaponized FOMO to some extent.
I like that.
And
I'm getting the T-shirts made right now as we talk, Steve.
We'll work out royalties later. But I do think this was it. This was the ultimate catch-up trade. We had people underinvested all year. They wanted it in, and they wanted it in a hurry. And the other thing to keep in mind is if you're playing off a 2 and 20 type of thing, if you can goose up your returns in the last month, it counts just as much as if you made the money in January.
Wait, window dressing? Nobody does that.
No, we're not seeing any of it.
Yeah.
And so, so that's my concern, is that we're sort of getting into this environment where, where no one wants to get in front of Santa's sleigh, but it's been on a roll for, well before Christmas. And certainly this is the week you expect to see it anyway.
Steve, Carol may want a little bit of an extra payment on the moniker of
I've learned from Kim Kardashian.
Weaponized FOMO. Listen, we're all looking for the alternatives. So that's not just the individual, the retail community. That's also the institutional environment as well. The question: you look at the bond markets, European bond markets waking up. They rally like Billy O this morning. U.S. bond markets are really hitting some extreme positioning. The question of weaponized FOMO then becomes, going into 2024, where is the most weaponized FOMO? Is it for equity, or is it to be long of bonds?
Actually, it's kind of both, Manus. I think that's a hedge.
That's a hedge, Steve.
No, it's not. Everybody's in on the party. I was out with a few friends recently, and one of them was a retired bond portfolio manager, and his comment to me was, he goes, "We couldn't give bonds away at 5%, and now at 3.90, everybody can't get enough of them." And so I think that really, it's been this huge change in sentiment. Bond portfolio managers, by the way, are not immune from the pressures of needing to beat their benchmarks or their own FOMO. And so I do think, it becomes a virtuous circle, though. If stocks start running, well, then people start looking at fixed income. Of course, if fixed income is running, well, that's always good for stocks. So, we're really just getting money flying in from all corners, and it's chasing returns. And I do think it's very interesting that it's chasing duration. As we still see from a continuing inverted yield curve.
Well, so you're seeing that in duration. Let's talk about the front end of the yield curve, though, because that bid into cash, it feels like nothing has been able to stop it for over a year at this point. Do we start to see maybe that money migrate out, or what's your prediction there for where people actually pick along the curve?
Depends what happens in the economy, Katie. And I know that's not meant as a hedge. This is meant as what I see as the existential question going forward. Is, if we're going to get a soft landing, which is constructive for equities, we're not getting 6 rate cuts. If we're going to get 6 rate cuts, which drives money back into risk assets, that's probably because the economy stinks. It's hard to reconcile both of those. And that's really the question that we have to concern ourselves with. Are we going to get a soft landing, or are we going to get the hard landing that still we can't rule out as being priced into bond markets when they're looking for, when the Fed says we'll give you maybe 3 rate cuts, the market was already expecting 4, and the market says, you know what, I see your 3 and I raise you to 6.
Don't you feel like that could be the big miss if we are just being so kind of over-expecting how aggressive the Fed could be. And if we miss that, that could be a real change case.
That feels like the biggest fight that's definitely brewing heading into 2024. But Steve, I'm not saying that you're hedging, but let's talk about hedging overall, because we're taking a look at the VIX right now, looking at 13 when it comes to that handle. When you take a look in the options market, when you take a look at put call ratios, et cetera, is there that appetite to hedge, or is this just a green light to go all in on risk?
Well, I think, again, are you thinking like a contrarian, or are you following the herd? I think right now the short-term trade is don't get in the way of the herd because the market is just so exuberant. And we still see, very aggressive call bids. Although one of the things that's interesting to me is VIX has started to inch higher even as over the last couple of weeks, which, bearing in mind that VIX is a 30-day look ahead, that's how it's constructed. It's telling me that people might be preparing for a little more volatility.
It's at 13, Steve.
Oh, no. Believe me, people are not hedging. When I say dipping, they're dipping their toe in. The volume we still see is in call activity. One of my colleagues said, before the holidays was just every day I just see people coming in and buying upside calls in SPX. That's basically what I do for people, and that is still very much the mindset. And people aren't hedging. All I'm saying is what we're starting to see is a little bit of the VIX tick up, and VIX futures are starting to look a bit. VIX futures curve is very steep. So what it's telling me is, in the short term, people do not want to get in the way of this rally. In the longer term, they're maybe a little more cautious and expecting a little more back and forth volatility. And remember when that high, you mentioned it at the top of the show, was January 3rd, 2022. We finished January 2021 much like this, which is not to say history repeats. But, that was another period where no one wanted to get in the way of the rally, and it petered out literally on the first trading day of the year.
All right, so I'm wondering, are you ready to make a big bet for 2024 in terms of if you had to go all in on one investment idea, what would it be, Steve?
Don't fight the pain trade. Right now, the pain trade is for markets not to continue rallying and for bonds to back up a little bit. If you get the soft landing, let's take the soft landing scenario. You don't see yields at 385 and a 3 or 390, and you don't see equities where they are because they can't cope with the idea of bonds going up 50 basis points. Or you have the six cuts materializing because we've had a hard landing, which is also not constructive for equities. So that to me is the biggest risk out there, and that to me is the one that I can't get out of the back of my mind, even as markets rally and even as we are, full on enthusiastic.
It feels like there are still some scenarios. I always have this expression from a friend of mine in college of ifs and buts were candy nuts, we'd all have fun at Christmas. But it's that point of there's a lot of ways that this could still go.
I'm still working around that tongue twister.
Yeah, I'm not going to try and do that iteration. I think the fact that you've got volatility so repressed, so depressed, as you said, so you're not getting that traditional flow of money into that, because many people would say, well, that's a waste of money, that's a waste of expenditure from the portfolio. You want to buy something more defensive. Well, you bought defensive stocks this year. You didn't exactly do very, very well. It's a question then. It goes back to whether it's large caps or small caps, and it's been the best. Small caps will earn 8 to 9% next year, and that is probably one of the best entry points since 2001 on small caps relative to the big caps, and that's going to be the debate for 2024. What is the catch-up trade?
Well, Manus, to your point, you take a look at the sector laggards for the year. Right at the bottom, you have utilities down almost 11%, followed by consumer staples. Defensive stocks, they've not worked. And you think about how that bleeds into weaponized FOMO to steal that.
Phrase.
Yeah,
Steve Sosnick, we're going to get caps as well, and you're going to get a big part of the royalty on that one. Steve Sosnick of Interactive Brokers, we thank him for his time this morning. Really bringing up, though, that idea of, we've seen such aggressive thought in terms of what we might get for the Fed, and maybe that doesn't play out. And what does that mean for a reset? And what if we do get not that soft landing, but a harder landing? That's a different story.
Yeah, so much of that power pivot, was poised in there. And we've talked about global growth. Global growth will slow down next year. So the question then is, does U.S. exceptionalism dominate relative to the rest of the world? MSCI All World kissing towards that record high as well.
Got lots more to talk about when it comes to the markets, folks. Don't go anywhere. Coming up at 7 a.m., Dana Dioria of InvestNet Solutions. This on a day where it's again quiet. S&P futures are little changed. This is Bloomberg.
What's happening happening is that the world posture of opposing any expansion of the conflict is inevitably eroding. Iran's proxies are testing red lines. They're seeing that some red lines are pink, and they're also normalizing a certain scale of violence.
And that, of course, is Norman Rule. He's former senior U.S. intelligence official, obviously making some comments on the Middle East, something that we continue to watch on this Wednesday. Also, watching the markets again, it seems like another quiet day here. We had low volume yesterday, but we continue to see the S&P 500 really inch towards that all-time high. Right now, 48.23 is the print on S&P 500 futures. Folks call it unchanged. We're just down about a point. Cross with the euro, U.S. dollar, 110. Looking at that 10-year with 387, just down a hair. Call that unchanged. New York crude, though, also backing off that rally, pretty significant rally, 2.7% higher yesterday on concerns about escalation in the Middle East. Right now, we're down about 0.7%. So a little change there, but a little bit of a pullback. Let's get to it. Let's talk about the Middle East. We've got a great guest to talk about geopolitics and politics here in the United States. Wendy Schiller is policy director at the Taubman Center for American Politics at Brown University, joining the team here. So, Wendy, we do need to start with the Middle East. When you look at the situation and the news flow, and we do feel like it comes sometimes cryptically, and there's meetings at the White House, and there's stuff going on overseas, and we're watching the Red Sea and so on and so forth. Would you make a bet on further escalation and this becomes a more difficult situation, or do you see a means to an end somewhere maybe in the new year?
Well, I think the problem for the Biden administration is that these other skirmishes may not be directly related to what Israel decides to do in terms of bombing in Gaza. So Israel has said they're not going to let up, they're not going to stop and slow down. But of course, we know that they can decide the opposite and decide, due to U.S. pressure, dealing with Egypt, maybe that they eventually accomplish goals sooner than they think, and they'll ease up on the bombing. Then you have a massive refugee crisis and a massive rebuild project in Gaza, whatever that looks like. That's one territory. But it could also be, as you say, that Iran decides they're going to ramp up with their proxies in lots of different areas. In Iraq, we had service people injured, obviously Syria, obviously Yemen. So those become distinct and separate. That's a proxy war between Iran and the United States. So that's a different ballgame, and that is harder to explain to the American people. And that's the political problem with the Biden administration.
But one that needs to bear is close watching. Iran, what do you think their mission is or their goal in all of this?
They want to destabilize the United States and make the United States less influential in the global, both economic and military and political sphere. That's their goal. Remember, we gave them access to some of the money that was theirs from selling fuel and selling oil, and then we pulled back on that access after October 7th. So we do still control their access to money, and we still have heavy sanctions imposed that are supported by, a great many countries around the world. They want to get out from under those sanctions, and they want to be able to operate like any other country. And the only way they can do that is to destabilize U.S. influence around the world.
And that's where this multi-front sort of proxy escalation is the concern for everybody. Yesterday, we saw a readout from the Biden White House and the Emir of Qatar. They are now focused very squarely again on hostage release. Do you expect significant progress? Is that the next line in the sand that we need to keep an eye on? The White House saying that Biden and the Qatar Emir also discussed efforts to increase aid, and that hostages being released was on that agenda. How significant is that in terms of progress and helping the situation?
Well, if Hamas knows where all the hostages are, remember, they farmed out literally the hostages they had taken to different splinter groups. So if they actually do control where they are and whatever condition they're in, then there is a possibility that this can conclude more quickly and the hostages can be released. But we don't know, at least the American public doesn't know, and it's unclear, the Biden administration hasn't said whether they have that knowledge. And that's the first step. And certainly getting the hostages released will decrease any remaining residual support for Israel in aggressive bombing in Gaza. So, of course, the Biden administration wants that to be the linchpin of the next couple of weeks of their negotiations.
Will there be more pressure from this White House, or should the question that we asked yesterday on this show, should there be more pressure at this juncture on Netanyahu to seek a pathway to de-escalate, and hostage release is perhaps the most visible vehicle for that? Will there be more pressure from the White House? Politically, can Biden bring that to bear on Netanyahu to de-escalate in any way?
Well, Israel, I think, is not feeling as if the world is particularly friendly to their cause or sympathetic to the massacre that happened on October 7th because of the subsequent loss of civilian life in Gaza. And so I'm not sure how much the rest of the world, including the United States, can say to Israel, stop. We haven't passed, as a country, we have not passed an additional aid bill for Israel. And I think that plays into this. Why should Israel listen to us if we can't even get, or the Biden administration cannot even get, an aid bill through the Congress for Israel? The incentives to listen really diminish if our effectiveness in terms of providing aid diminishes. So that's one issue. And then Trump. We haven't talked about Trump. If Trump wins, as he's expected to do, we'll see Iowa and then also New Hampshire, and it starts to roll, he will ramp up enormous pressure on Biden not to abandon Israel, not to pressure Israel. And his rhetoric could be really incendiary. And that is another complication for the Biden administration when it comes to getting anything through the Republican-controlled House.
Well, Wendy, let's talk a little bit more about Biden, the politician, Biden, the candidate in the 2024 election. There was a really interesting poll out this month from Quinnipiac that found that support for sending financial aid to Israel to fund the war with Hamas is quickly deteriorating. Look at some of these numbers. In December, it was 45% of registered voters saying that they want more aid for Israel, which is significant, but that's down from 54% in November. How does Biden, running for office, trying to appeal to American voters, handle this and message this?
Well, there's vocal constituencies on a lot of sides. There seems to be more sort of mass protest-based advocacy for not giving Israel this kind of aid. And then there's, of course, some very powerful voices that are saying, yes, we support our allies, and Israel is a military ally in the Middle East. And that's the argument to be made. But you can see even in the House of Representatives, a number of Republicans don't want to give money to Ukraine, for example. So they wanted to separate out the Israel aid from the Ukraine aid, and Biden's saying no, because he understands he'll never get Ukraine aid from the House if he decouples them. But the appetite for spending billions of dollars, of American dollars, on munitions in particular, on bombs that will be used to kill people, I think is diminishing quite a bit. And that is a real problem politically, practically for the president in the Congress amongst his own party members, but also amongst Republicans.
And Wendy, to your point, when it comes to aid for Ukraine, obviously Congress wasn't able to get that through in 2023. Republicans really standing their ground and sticking that to border security. What does a potential compromise look like in early 2024?
Well, I think that, Katie, totally depends on what happens with the very current border crisis that's brewing now. We have a very large number of migrants making their way to the border. The Secretary of State is going down to Mexico to figure out what to do. That is going to soak up a tremendous amount of attention in the American public's mind. And I think that is a very important sort of mini crisis for the Biden administration going into that election year. Because if they don't handle that well, we know that Trump or Nikki Haley or Ron DeSantis will make that their key issue. And there are a lot of people in this country who will vote on that issue rather than casting a vote on Ukraine or Israel.
And that's what I wanted to ask you. 20 seconds, Wendy. What is the most important issue? We used to say it's the economy, stupid. But what is it when it comes to American voters when they go to the poll in November? And just quickly.
I think it's still the economy. If the economy is good, American voters will have the time and attention to devote to foreign affairs. If the economy is still shaky, that is what they're going to worry about. And they're going to say, why are we worse off than we were 4 years ago? If they're better off, I think you have to give the edge to the incumbent president in all those circumstances.
All right, covered a lot. Thank you so much. As always, Wendy, Happy New Year. Wendy Schiller of Brown University joining us there. But I do think that's interesting. I want to talk a little bit about the economy because, the labor market is still a tight labor market, right? But we talk about high prices are still problematic. High rates are problematic. How does that ultimately impact Biden when everybody goes,
ultimately it
as
is
a standing president?
Ultimately, it is what kind of slowdown do you get? We talked about a silent recession yesterday, but wages remain strong. They remain firm. And for as long as wages remain firm, then this American consumer will remain robust. The longevity of their spending will endure. And so long as there's no massive break and hard landing, then the consumer remains fine and informed.
But is that enough for
Well,
Biden?
do they believe in Bidenomics?
Exactly.
The bottom line is, do the electorate really believe that Bidenomics has made them better off?
Paul Krugman has talked about messaging that the White House has to get out there, but we're a long way still from November. All right, coming up at 6:45 a.m., Kona Huck of ED and F-Men on the commodity market. Lots to talk about there. This is Bloomberg. audience worldwide, a very good morning. This is Bloomberg Surveillance, live on Bloomberg TV and Radio, alongside Manus, Cranny, and Katie Greifeld. I'm Carol Massar. We are in for Tom, John, and Lisa. Quick check on the market boards on this Wednesday morning. And another quiet morning, as you can see, S&P 500 futures call it unchanged. Watching to see, though, if the S&P can ultimately continue this late 2023 rally, Santa Claus rally, as many are calling it, and see an all-time high. You're laughing, Katie.
I just think it would be poetic if we had one day this week where the S&P 500 was perfectly unchanged. I think that would really tie a bow on this experience.
Deep down, she just wants a red headline. She wants to be the one that breaks the red headline. The S&P 500 breaks into a new record high.
Yes.
All right. We're also watching oil backing off of yesterday's rally. I'm just going to move on from Santa Claus. The elves are asking me to move on. All right. Under surveillance this morning, let's get to some of the top stories. Wolfgang Schäuble, he is a key figure in German politics. He has died paralyzed from the chest down after being shot by a gunman at a political rally back in 1990. Schäuble rolls through the Christian Democratic Union Party, going on to serve as Angela Merkel's finance minister in 2009. He was 81. In terms of corporate news this morning, Apple appealing a U.S. ban on the sales of some of its smartwatches after the White House refused to overturn the measure. Apple has already stopped selling the most popular watch models after a patent dispute with Massimo over the use of its blood oxygen sensor. Now, the tech giant will now challenge the ban in the U.S. Court of Appeals. It's also filed a motion to have the ban lifted while the court appears and considers its appeal. And then Tesla, poised to lose its title as the world's most popular EV maker, with China's BYD set to pass them in sales in the current quarter. BYD overtaking Tesla's Elon Musk's company prepares to roll out a revamped version of its Model Y vehicle. They've been pushing for them to make some changes. According to Bloomberg, production on the new Model Y will begin midway through next year and feature both interior and exterior changes. What's catching your attention among those stories?
The Tesla story, this is what we were talking about with Dan Ives yesterday. When you think about all the different bear cases out there for Tesla, it's China. And it was just kismet to see the story on the terminal today. Here is a fun stat that Tesla only sold 3,456 more EVs than BYD last quarter. So seems like it's pretty close to actually taking the crown.
Well, that takes us back to that conversation. Betty Lou, who used to work here, of course, she went on to do other things. She had that conversation back in 2011 with Elon Musk. And we were just chatting about this in the break. What did he say? He was sniping.
He was kind of like, BYD, like no problem, right? Like he was not, not giving them any props. Yeah, exactly. Apparently, I think that's gotten out on Twitter, and he's thinking a little bit differently this morning.
Yeah, big time. He can't exactly laugh right now. There was an interesting little exchange online. You had a Tesla Owners Club sharing that clip in May of that 2011 clip. And then Musk actually wrote back that BYD's vehicles are highly competitive these days. And that man would know.
Be careful what you put out there, because it lives for eternity.
It's very different strategies, though. I mean, Teslas are expensive, no doubt about it.
Well, they've been cutting prices all year. Every single quarter, you just came in, another red headline, another price cut in China, and around the world in terms of the models.
But BYD, right, offering a lot of models out there, certainly for their domestic market and elsewhere, but that are at lower price points, almost, from the get-go.
And maybe a saving grace for Tesla here is that we're really talking about China here. You can't really buy a Chinese-made EV if you're in the U.S. It seems like Europe is trying to pursue that model as well. But still, you think about for Tesla's growth, China matters a lot. And those domestic vehicles in China are really what people buy over there.
I think it's worth just pausing for a beat, because one of the, I grew up in the UK, I grew up in Europe, and I grew up as part of Europe. And one of the perhaps figureheads of the debt crisis.
I'm glad you're going to go back there.
Is Europe. It's Schäuble. He's passed away, 81. He was a veteran. He and Merkel were symbiotic of what German fiscal prudence was. And we've had a massive row over fiscal largesse in Europe and Germany over the past 6 months. He was the man that challenged the Greeks. He said, you don't want to play by the rules. This was during the debt crisis, during Brexit, as it was famed then. And he said, you know what? If you don't want to play by the rules, take 5 years time out. Then he came in line with Angela Merkel. He was a formidable politician and a formidable finance minister who in many ways, Draghi may have saved the euro, but Merkel and Schäuble were perhaps the trifecta of that pillar.
And bringing him back in, right, after the 2009 crisis.
Yes.
So crucial in terms of certainly the German financial situation, right, and banking there. So there are people who've just had tragedy, obviously, right, but so important in terms of very significant points in Germany's history, right, and just kind of geopolitically overall.
Absolutely, from Tesla to political icons. Let's turn our attention now to one former political minister. It is the former UK Prime Minister, Gordon Brown. Bloomberg opinion columnist Mohamed El-Erian and Nobel Prize-winning economist Michael Spence sat down with Bloomberg's Jonathan Ferro. That was earlier this year. They were talking about the book Perma-Crisis, a plan to fix a fractured world. They discussed the impact of AI and how that could hit productivity.
When Gen AI came along, and I saw its sort of multi-domain capability, the fact that you can use it with no technical training, just a little bit of practice, creating prompts, and its applicability pretty much everywhere. I thought, even though it's early days, and we're in a period of exploration and experimentation, I think it's a reasonable forecast that this tool is an important part of a future productivity surge, and if it comes, it'll make it a lot easier to do inclusive growth patterns because it won't be a zero-sum game. It'll be easier to invest multi-trillions of dollars in the energy transition. It's going to be terribly difficult to get that done with fiscal space declining, the rising debt levels, and rising interest rates. So that's why we spend a fair amount of time. It's not that the growth by itself is the only thing. It's that it enables an awful lot of what we want to accomplish.
Yeah, I think we're heading for a low-growth decade if we don't have the productivity surge that AI can give us. And I think what Mike is pointing out is it can transform a whole range of industries. You'll never see the accountancy or legal or even medical professions or teaching profession be the same again if AI has the impact that I think and Mike thinks it will have. But equally, we've got to have that productivity surge, because without that, the inflation, the fiscal space being narrowed, the debt that we're running, and of course the supply side shocks and constraints that are in existence mean that as things stand, we're heading for a low growth decade. AI is the way forward to take us out of growth, and I think Mohamed agrees with that.
No, totally. And it's critical because we have a debt issue that has to be resolved. We have an inequality issue. We need resources for critical transitions. So, the notion, as Mike and Gordon correctly said, that higher, more inclusive growth and more sustainable growth is a massive enabler to deal with all these other problems.
All three of you understand the risks involved, though. If globalization hollowed out manufacturing bases domestically in places like America, in the United Kingdom to some extent as well, and I'm asking the question, why wouldn't AI do the same thing to services? My question, if I'm a member, a citizen, someone who's got to vote, is why would I trust the same people all over again? Who should I trust to manage that transition and that integration of those technologies?
That's what my children say, my young teenagers say. You guys have messed it up. And it is true that we tried to create a more inclusive system. We tried to deal with the problems of the environment, but we couldn't get the agreement that we needed. And we tried to have more equity and better jobs. But I do think when I talk to young people, they want to see this change. The issue is not whether you have change or not now. The issue is what kind of change, and we've got to make that change inclusive.
Mike?
Agree. I mean, Eric Brynjolfsson talked about the Turing trap. The Turing test basically pushes you in the direction of automation. We want to push, in policy, should be pushing in the direction of augmentation, of giving people powerful tools that make them more productive. So this is the journey we're setting on, but it's not, I don't think, right to just capitulate and say productivity produces employment problems. It's at least more complicated than that, Jonathan.
But our global institutions have got to reform to be capable of dealing with this. They're not fit for purpose at the moment. And the IMF has got to be a crisis prevention mechanism. It's to do proper surveillance of the world economy. It can't just be there for crisis resolution. The World Bank has got to become a global public goods bank and deal with the energy transition as well as human capital. The World Trade Organization has got to find a way of diplomacy and negotiation and arbitration working better than it has in the past. And we need a better concept of burden sharing. I mean, I cannot understand why when you have a humanitarian crisis, and we have many around the world at the moment, all we seem to be able to do is pass the begging bowl round and hope that someone's going to produce some money. We've got to have a system of burden sharing, whether it's for the environment or whether it's for public health or whether it's for some of the other global public goods we want to do. Now, if you talk to people around the world, I've just come back from the United Nations, they all want this to happen. So what we need to do is show that this can yield the best results and then create the political will for this to happen.
As I'm listening to you, I'm getting the same feeling that I got when I read the book. This makes a lot of sense. And then I end up in the same place. Is there any evidence that people are willing to vote for it? Now, you say it's incredibly popular. You go around, you speak to people, and they're convinced by it. I don't see any evidence from recent general elections that anyone wants this vision that the three of you have.
I think people want hope. I think the lesson of COVID and of the energy and food crisis and people's reaction to the war in Ukraine is that things have got to be better than this. And I think those leaders that can show that there's a hopeful future. Now, you see Mia Mottley in the Caribbean producing her plan for global growth. You see now politicians in Africa talking about green growth. I do think that there's a movement now that says, look, we cannot have politics just as a negative sport where people are just attacking each other and it's all sort of about sound bites. I think people want politicians that can give them hope, and that's the next generation.
Mohammed?
I think he's absolutely right. I mean, there's A, people want hope. B, I think there's a broad recognition that the road we're on is unsustainable and it's getting more and more bumpy. And third, we're dealing with the loss of trust. And if we don't directly re-establish trust in our institutions, in our policy making, in global cooperation, things are going to get worse. I think the reason why we wanted to put this down is hoping to start a conversation on a set of steps. And we keep on saying there is no silver bullet. This is not a big bang, you do something tomorrow and then everything's fine. This is building a foundation that turns vicious cycles into virtuous ones.
That was Bloomberg's Jonathan Ferro in conversation with Gordon Ban, Mohammed El-Erian and Michael Spence a little bit earlier this year. Great conversation about where AI takes us, you know, and I think Jonathan's question was very prescient, which is, will the electorate want to vote to enable this kind of thing? One thing that comes to mind is the regulation of AI and where are governments in that conversation. The conversations that I'm having is that there's virtual silence from government. They didn't get it right over the internet. They did not get it right over the internet, many global governments. And what are they doing to regulate AI? We barely know what AI means.
Well, that's what I was going to say to you. It's early in the game, and but
that's where good governance comes from.
We have learned from social media that we were too late in the game in terms of monitoring and oversight. So we've got to be smart about it. I don't know. I think I've said, hey, if AI can write a script for me and write some introductions and I edit it, I love it. Like, right, that to me does assist.
But then you have to really fact check it, you know?
Absolutely.
Sometimes it would be easier to just write it yourself. But I do think that's an interesting and important question. What is AI? Because you think about the public conversations that are happening, it's mostly around chatbots, you know? It's that flavor of...
We use AI already.
Yes,
yeah, we do, but I mean, to what extent is it going to evolve? How quickly will AI evolve and immerse itself? I mean, I remember, I don't know where the iPhone's gone. I remember when I got that, and it might have been 2007. We've come an exceptionally long way. Where I said, I'll never watch a video on this. I'll never ever watch a TV program on this. What are you doing? What are we all doing? We're watching Netflix, you're watching Instagram.
But autocorrect is still so bad. And we think about the flavors of AI in our life, and autocorrect is still terrible.
That's the speed of the evolution. From 2007 to where we are now, the speed of the evolution in AI will be even more aggressive.
Yeah, I guess. I think there's more that we need to learn. I think in terms of the medical community, I think when we talk about disruption, there's certain segments of our economy that are still lagging. And I think what it could possibly do in detecting, you know, irregularities in scans and so on and so forth, I think it's more difficult for the medical humans to do that an assist from AI could be.
It's probably more important than just writing scripts, you know, the medical implications. So.
End of the world, solving all of our solutions. I don't know. Maybe
uplifting thought.
Maybe it's a question for Kona Hack, but we're going to actually talk commodities with her. She joins us next.
Every week that transit through the area is difficult, will have a big impact on trade flows and big impact on freight rate. But the first consequence you would see, and we're seeing it already today, is that freight rates will start to go up. Obviously, the second consequence you will see in a couple of weeks from now is that the supply chains will be distorted heavily, a little bit like we saw with Ever Given and during the COVID crisis.
And that was Alexander Savory, CEO of crude shipper Euronav, talking to us earlier this month as tensions in the Red Sea escalate, something we are watching once again, too, on this Wednesday morning. We do want to talk a little bit about the commodities market. Certainly been keeping a watch on oil because of the concerns about Mideast escalation. You've got New York crude. It's pulling back just a little bit, down about 0.7%, a 55-cent decline. So 75, call it, a barrel. That after about a 2.7% run up yesterday. And we saw that escalation 24 hours ago. It just kind of built through yesterday's morning. But again, we're taking a little bit of a breather this morning. Let's get to commodities, because it's been an interesting year. We lump a lot of commodities together, but there's lots of moving parts to the space. Kona Hack is head of research at ED&F Man and joining us here on Bloomberg Surveillance. Good morning. Happy holidays. So let's talk about oil to begin with. What are your thoughts about what's happening in the Middle East? And should we, as investors, be more concerned that there's going to be more pressure over there, and that's going to kind of play itself out when it comes to oil prices and energy prices?
I think oil is a little bit interesting, in fact. It's the first time that 2023 will see oil prices decline in 2 years, I think as a year as a whole. So we're actually starting at relatively cheap prices, if you like. So 2024, you could almost say, in my opinion, oil is fairly cheap. Now, there are good reasons for that, because the markets are pretty well supplied. We're going into 2024 with demand slightly weaker, because after, almost 2 years of rate cuts, clearly oil consumption might be impacted. On top of that, non-OPEC has been producing a lot, particularly from the USA. But as you mentioned, we have so much geopolitical risk out there. And I have a feeling that you will be very vulnerable to occasional spikes, maybe not even occasional, regular spikes, I think, as and when this Middle Eastern conflict starts to develop. Worrying signs of escalation, you'll see a notch higher. And then if that gets notched back, then you'll see an equivalent drop. I think the reason why we haven't moved higher is because there is a fair amount of spare capacity in OPEC. The fact that Saudi Arabia, Russia, and the big oil producers in OPEC have cut back or are pledging to cut back in 2024 implies a healthy amount of spare capacity. So,
well, Kona, let's just pause for a moment on that. We're going to get volatile spikes. We understand that with the geopolitics. First of all, are you surprised that you haven't seen a bigger spike? 6% is not exactly what I call war premium. But then to complement that, you talk about what's going to happen in the first quarter. There is an assumption of deficits in the market in the first quarter. Will they come to bear as OPEC plus hope?
Well, my assumption is that the deficit comes in the second half of 2024, and that's assuming OPEC maintains all their pledged cutbacks. So actually, this first half is fairly okay. We assume that demand's going to be not terribly tight, and supply therefore should be decent. Now, considering that, any spike due to escalations in the Middle Eastern conflicts could be managed properly. But in the second half, I think that's when I think things could start becoming a little bit tighter, because my assumption is that that's when the markets actually move into outright deficit, assuming the pledged cuts take place.
So the first half is going to be tricky. Where is the floor in the first half? And do you expect Saudi Arabia and Russia, who are the two biggest protagonists within OPEC Plus, to have to significantly extend the cuts that they have promised?
I believe they will have to, yes.
For the whole of 2024? Extend the cuts for the whole of 2024?
I think so, yes. Because the demand outlook is not as rosy as it was back last year. We have China that's still struggling at 4 or 5% GDP growth, and the European economy is also looking fairly stagnant. So I think all around, wherever you look, demand's not going to be as strong. So I think to balance that, OPEC's going to have to do their bit.
Let's just broaden the conversation slightly. We're going to debate where the dollar goes, whether it's king dollar exceptionalism that takes hold next year. Now, the market at the moment is grappling with 150, 160 basis points of cuts. The dollar has come back ever so slightly. You would say the base level for all commodity thinking in 2024 is going to be where the dollar goes. It's certainly going to be a big protagonist. And you say, hold your horses. It's not the demise of the dollar just yet.
Yeah, that's my view. I think that the US dollar has always proven to be stronger than the market likes to think it will be. Yes, we've had quite a serious escalation in interest rates in the Fed, and that has definitely prompted support to the US dollar. But that doesn't necessarily mean that as we start cutting or even leaving at rates at this level, that doesn't mean that the US dollar starts to weaken substantially, purely because the US economy is so strong. And I do believe that the US will not be able to cut interest rates as rapidly or as early, if you like, as maybe the Bank of England or the ECB. Therefore, I think the European Union, Bank of Japan, ECB, all of these central banks will actually end up, because of their weaker economies, are going to have to cut earlier than the Fed would, which ultimately will mean the dollar on interest rate differentials will remain stronger.
Well, on the dollar and its relationship to the world of commodities, it's been really fascinating watching gold over the past few months. Just this month, in December, gold hitting a record high. You really didn't hear a lot of hullabaloo about that. How much, though, does your view on gold and on some of these other commodities depend on what happens with the dollar?
Yeah, so if we assume, as I was thinking, that the dollar doesn't fall too much from these levels, I think there's a bit of weakening. A lot of it's already happened in the last month or two. But if the dollar stays steady at or around these levels, then it holds that the gold, commodities like gold, for example, should also maintain their levels. They shouldn't necessarily rise higher. What's supporting gold, of course, is geopolitical tension, so safe haven demand. That's something that's benefiting the Swiss franc, the US dollar, but obviously also gold. So I think the gold prices could do well, just on the fact that we have a stable dollar and continued safe haven demand. But when you're talking about other commodities, I would say also I'm not particularly bullish. I think you have to look at individual commodities. You've got the likes of agriculture, where certain weather issues will cause tightness in key commodities, but metals, on the other hand, may struggle depending on demand from China.
Let's talk about some of those other commodities, because there's a lot to pick of from. You look at rice at a 15-year high. You take a look at cocoa at a 46-year high. Some really amazing moves outside the world just of energy and of oil. Is that basically just explained by some of these extreme weather events that's going on, or is that a supply-demand story?
So it's both. It's weather, which is particularly due to El Nino, this weather phenomenon which causes particular dryness in Asia. So that's directly impacting rice yields in the likes of India, Thailand, China. So I think that's caused supply disruptions in rice. El Nino is also causing weather disruptions in West Africa. So the cocoa producers like Ghana and Ivory Coast have seen very dry weather there. So yields there are also under pressure. So I think you're seeing spikes in those markets. So I think that will remain a risk for a lot of the agricultural commodities. But grains, after the Ukraine invasion, the spike higher did lead to a huge supply side response. So grains actually may not see such a spike outside of rice.
Hey, just one last question, because I feel like you can't talk commodities without talking China. Just got 30 seconds left here, Kona. I mean, how do we need to think about China's role when it comes to commodity demand broadly?
Yeah, so this is where the property sector really matters and how China will stimulate their economy. There are rumors that, and markets are liking the idea that there's going to be more stimulus that should benefit iron ore and maybe copper. Copper will benefit from transition materials. But overall, I think China, you cannot expect China to be like it was back in the mid-2000s. You just don't have that kind of growth, and the property sector is not that much of a pull for commodities.
Yeah, we did have a headline this morning, China cutting its use in demand for soybeans. They are trying to really bolster their grain security domestically. We see that move by a lot of countries. But when China does it, it really impacts so much. Kona, thank you so much. Kona Hack of ED&F Man joining us here on this Wednesday. But I do think about, I thought it was interesting what you brought up, some of the moves that we've seen in commodity prices. We talk so much about bonds, obviously the equity market's global, but it's an important part.
You got to look at agriculture. You got to look at soft commodities. I was quizzing Manus you a little bit in the commercial break because these are really underappreciated corners of the commodity market.
You know what I started trading in 1991? This is a Tom Keane moment. This is a flashback for everybody. In 1991, orange juice futures.
No kidding.
There you go.
Wow.
And cocoa.
Wait, is this trading places? Wait, did something just happen all of a sudden?
Good morning.
Where's Eddie Murphy when we need him? No, No, but very important. And we thought about that with the war in Ukraine. All of a sudden, we were talking about the grain market. So this is
very real
really
and very
important.
aggressive markets.
All right, coming up, everybody. Dana Dioria of InvestNet Solutions continuing to focus on the market trade. This is Bloomberg.
Really, the last 2 months defined 2023 markets.
I think we're going to see more money flow into the equity markets simply because those yields are going to keep coming down.
We're normalizing something else, but the big shock and awe are behind us.
I think you're seeing these rolling recessions, with different sectors doing poorly in different environments. And I think that continues in 24.
2024 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, a very good morning. This is Bloomberg Surveillance, live on Bloomberg TV and Radio. Alongside me is Massar, Katie Greifeld. A very good morning. I'm Manus, Cranny. Not your usual lineup. Day 2 in the Bloomberg Surveillance house.
I look just like John.
Let's go rogue. Let's get a red headline out in terms of the potential for a red headline for record high in the S&P 500. We are 0.5% away from that. We're 4.5% away from global equity markets making record highs. Bonds are doing the big moves this morning, but my favorite phrase, and I think we christened it today, it is weaponized FOMO, and that's from Steve Solznick, which is what is fear? Fear becomes greed, and greed for some people in equity markets is good.
Well, if you're a money manager and all of a sudden your investor says, hey, wait a minute, where's my returns? Because you missed out on some of the momentum plays, you got to answer to that.
I will say, even with all this talk about weaponized FOMO, and I think obviously that explains a lot of what we've seen over the last 2 months, we've really slowed down. You talk about that 0.5% away from the all-time high. It has just been painful to try to get there. We are talking about
like
such
a healthier
small
trade?
moves.
Don't you feel like when we kind of have a little bit of a painful climb, that I feel like it's a healthier move, that it's not just a run-up without kind of thinking about fundamentals?
Well, nothing in this world is good without a little bit of pain. One big set of markets that are moving this morning. Let's have a look at the global bond markets, because you've got UK bonds, bunds, and US Treasuries. Of course, the European markets are playing this catch-up trade to the United States of America, but you are seeing German 10-year government bond yields hitting the lowest level since 2022. And this is about the momentum of who will cut first, who will cut fastest. And I love the line from Solznick, which was at 5%, you couldn't give US Treasuries away because everybody was paralytic with fear that we're going to hit 6%. Jamie Dimon even moved at 7%. But at 3.5%, where are we now? 3.86%. There's a race. There's a gorging on global bonds.
And our last guest just talked about, what's happening in Europe, that they might have to cut sooner than the U.S. And this is where we need to start thinking about the impact on currencies and the different gaps between various assets globally, but that it might take the U.S. longer to get to those cuts. So we're going to start maybe seeing some differences in terms of that pullback on rates.
That's certainly the expectation of the market. I mean, you take a look at what's priced in for the ECB, for the Fed, it's pretty much the same when it comes to the total magnitude of the rate cuts. But like you said, Carol, it seems like consensus out there is that the ECB has to go first.
Let's just circle back to where we were 24 hours ago, because global geopolitics is at play. We topped off yesterday morning with attacks in the Red Sea and targeted attacks by the United States into Iraq. But there's been an evolution overnight of Biden with the Qataris talking, and they're talking about hostage release. So it seems as if the political discourse has shifted a gear in the past 24 hours between the United States and those brokers, which are the Qataris.
Has it, though? I don't know. There's a lot of discussions going on. Does it lead to ultimately action where something changes?
Well, the Qataris were instrumental in driving those hostage releases in the first instance, and they are, well, perhaps, unfortunately, one of the most direct conduits to Hamas.
Right, for better or worse.
So we'll see if that actually materializes in hostage release. We know that the Biden administration would certainly like to take some of the escalation fears off the boil. They would certainly like for Israel to maybe not continue with this full front war here, but a lot of big questions for the Biden administration, especially as Biden, the candidate, emerges.
And I thought it was interesting what Wendy Schiller had to say about in terms of the role of Iran, that they want to see some destabilization in the United States. I would say Russia would love to see more destabilization in the United States. You know, so I think about all of these global players and what they would like to see as, you know, the nation that everybody turns to when there's economic uncertainty in the world, when there's political uncertainty in the world.
It's the balance point for Iran between trying to destabilize and enable those proxies, invigorate those proxies. Correct. To what extent do they allow the proxies to really run riot versus their opportunity to get major funds re-released to them? And that is the issue. Quick snapshot of equities and bonds. We've talked a little bit about this. Equities are 0.5% away. We're just a little bit flat at the moment on the S&P 500, 48.23. Euro dollar is a little bit better bid this morning. The euro, the dollar, of course, will remain resplendent according to ED&F Man, and that will drive your commodity trade for next year. Oil is down by 0.6% after having put on 2.8% yesterday. So that's the state of play on the markets. The snapshot at 7:05 this morning in New York. Daria is co-CIO at InvestNet Solutions. Good to have you with us. They couldn't give bonds away at 5%, and the world is gorging on bonds at 3.8%. Not my words, but those of one of our guests in the last hour. Are you prepared to feast on bonds? Do you feel some sense of weaponized FOMO in this market? Good morning, Dana.
Good morning to you. And I would have to say yes and yes to both of those, you know, because, I mean, at this stage of the game, I think, you know, it's a question of when the Fed cuts and how much they cut. I land in the camp that, you know, the markets are maybe pricing in, you know, the likelihood at this point of a March cut is so high. I think that's probably overstated. And, you know, we're hitting one of these, you know, price to perfection type scenarios. But at the end of the day, you know, cuts are probably coming next year. So getting into bonds now does make sense. And, you know, obviously we work with financial advisors. If you're a financial advisor working with a client and you haven't kind of made this trade yet and figured out, you know, making sure that you've got the cash rates for your client that you should, you know, you should be doing it.
Doing it now, or do you wait a little bit?
I would. I don't see another rate hike coming, and it's difficult to think that, you know, I mean, at this point, you're really trying to time it, right, to wait for any increase in rates. You're hoping that there's market dynamics that drive it back up. But, you know, you have kind of a piece of information that's pretty certain, right, that going into next year, at some point, we're going to have rate cuts. And, you know, rates are effectively, it's an asymmetric payoff, I think, right? Or an asymmetric expectation.
I feel like it's a new parlor game. When does the Fed now cut rates? I mean, we've kind of switched the game for the U.S. Central Bank. Having said that, I want to talk large caps versus small caps, because small caps, you've got the Russell up about 17% year to date. That compares with about a 24% gain in the S&P 500. But since the end of October, small caps are up almost 30% versus a 16% bump in the large cap players. Small caps, and obviously it depends on what goes on in the U.S. economy next year and that rate move possibly by the Fed. What do you think could be the scenario for small caps next year, Dana?
So I am and have been a proponent of small caps, largely because the long-term research suggests that you do outperform there. Now, the smallest growthiest stocks, that's not the case. But if you excise those, small caps do tend to outperform over the long haul. So given that most investors should have some kind of time span there to wait it out, even if you get in and this risk-on environment, which I don't see anything coming anytime in the near future to quash that. So I think if you're getting in, you're probably still enjoying some of this momentum, and you probably still have a good runway. But even if you get in and, you know, there's some exogenous event or news, obviously something changes, holding on to those small caps now and, you know, kind of waiting it out probably still behooves you as long as it's a diversified position, particularly small value. So I do think this has legs to run. I do think it's amazing how we had this stealthy bull market in small caps just kind of come up, to your point, you know, in the last couple of months when it's been nothing but, you know, the mega caps all year long. So yes, definitely a proponent to, if you haven't diversified into small cap stocks, and you're missing out on that run, it's probably a place to go.
But not a blanket recommendation here to buy small caps. To your point, small cap value may be looking a little bit more attractive here. But what counts as a value stock to you? How do you actually define that when you're looking at the small cap universe?
It's a really good question, because we've had a lot of, just the distortion that the mega caps have and the Magnificent Seven have created in the indexes starts to really distort even those definitions, right, between value and small. I think, I'm a proponent of using a diversified definition, price to book, price to earnings, price to cash flow, an enterprise value type of definition. Put those together so that your definition of small cap value, or your definition of value within the small cap space, is diversified enough that you're capturing, kind of the economic underpinning of that idea that you're buying at a low price, as opposed to you're getting a particular metric. So when you're looking at your options, and it's easy to get into this space now, right? There's ETFs for everything. It's not a hard work type of a situation, I think, for most. You find a good ETF, well diversified, with a good methodology behind the metrics, and you've got a good position in the space.
And we'll be talking ETFs just a little bit later in this program.
You don't like ETFs.
One of my favorite topics there. But let's talk a little bit more about small caps, because the rally that we've seen since the end of October has just been extraordinary. You take a look at the Russell 2000, up something like over 20% in that time, well outperforming the S&P 500. Can that degree of rally, of outperformance, continue, or did some of that get pulled forward?
Oh, sure. I think you're right. Definitely when you have this kind of risk on, FOMO, you were saying it this morning, FOMO, weaponized FOMO, for sure, you're now seeing just this fear of, now I got to get into this. And what happens in that case, of course, is that, it's indiscriminate, right? You don't have people really looking. There's a big difference between these large cap growth stocks who can self-fund, who have access to cash, and really, don't need to go to capital markets, and small growthy companies that are just on the other side of even being in public markets, right? Need to hit capital markets. Even if they have termed out their debt, they still are going to be facing higher rates than they've faced ever before as they roll over their debt. And, that interest rate sensitivity that they'll have, even with the Fed cutting next year, which is obviously driving a good piece of this, it's still, from a corporate management perspective, that's still more difficult than the environment that they've been in for the last several years. So 100%, you're getting some indiscriminate buying there. And, those smallest, growthiest stocks in particular, I think, can be dangerous, certainly over time.
Dana, a voice of reason and raising a little bit of a red flag for us there. We can all just get a little bit too excited and buy some of those perhaps less robust growth stocks. Dana, thank you very much. Dana Daria, InvestNet Solutions, our guest, who has a view that maybe we're all a little bit too ebullient on what the Fed can do next year.
Well, don't you feel like all of a sudden, like, people are just kind of like, all right, let's calm down a little bit. Yeah. Like, maybe we don't need to think that the Fed is going to be like, all right, let's cut it $1 million,
now that we've had a couple days since that Fed meeting, and
they got to bring it back on the bridle, which obviously the racing's huge at this time of the year in Ireland. They got to pull those horses back on the bridle.
Half halt in dressage speak is what we would call it.
We got it all going on here.
Nicely done.
Yeah.
Did you go racing yesterday, Boxing Day?
No, I'm more of I like to stay pretty controlled, do some dressage, stay on the ground.
Much more poised and elegant rather than the races.
I would imagine that it really relates to monetary policy.
There's some. Well, and I do wonder, as we get into the new year, right, we're going to start to get near earnings. Then we've got Fed speak. Like, how do they start to massage the conversation?
I think next week they'll come out hard and heavy and try and get some restraint. Quick snapshot of what's going on in the equity markets. You can almost smell a record high. It's 0.5% away. On the S&P 500 this morning, we traded 848, 22.5. That is barely unchanged, down 0.05%, flat on the dollar. Euro's about a better bid, about 1/8 of 1%. 10-year yields 386. It's not too late to get yourself some bonds. That's what our guest said in the last conversation. Get in there if you haven't got the message.
Is that part of weaponized FOMO, though?
I think
buying bonds is not exactly what you call weaponized FOMO, ladies.
I don't know. You think about that move from 5% to under 4%? That feels like FOMO.
All I got to say is, Stephen Major, if you're tuning in, wherever you are, well, vanquished are the vigilantes, and well done to Major. I mean, it hasn't made exactly his target that he called for, but he has stuck to his guns throughout the year.
Yeah.
He really, really has. He's been absolute resolute.
It's not always easy to do that, right?
It is not indeed. Coming up, what are we going to do? More politics. Maya McGuinness, President of the Committee for Responsible Federal Budget, is joining us in just a moment.
Could also be, as you say, that Iran decides they're going to ramp up with their proxies in lots of different areas. In Iraq, we had service people injured, obviously Syria, obviously Yemen. So those become distinct and separate. That's a proxy war between Iran and the United States. So that's a different ballgame. They want to destabilize the United States and make the United States less influential in the global, both economic and military and political sphere. That's their goal.
A very clear delineation and separation of what is a proxy war for Iran against the United States as opposed to the Israel-Hamas conflict. A differentiation. Be aware of it. Wendy Schiller, Policy Director at the Taubman Center for American Politics at Brown University, with the team this morning a little bit earlier. To markets. If you're coming back in Europe, a very good morning to you. This is what you're looking at, which is an S&P 500 0.5% away from its record high. The question is, will the laggards pick up? Katie made this point. It was the utilities that were the laggards of 2023. Who will be the vanguards of 2024? Will it be tech? Will it be big tech? Will it be mega cap? Or is it time to look to small caps? Bonds traded 386 this morning. We have this wonderful phrase that we've encapsulated this morning. We have weaponized FOMO across equities and bonds in equitable amounts. If you haven't bought your bonds, roll up and buy them. That's what our last guest said. Oil gives back 0.5%, having added nearly 2.8% yesterday on concerns about the situation in the Red Sea and the US actions in Iraq. Well, there could be more disruption ahead on the fiscal front. That's what we're going to discuss now with Maya McGuinness, President of the Committee for Responsible Federal Budget. Maya, thank you so much for joining us this morning. There were lots of tense moments in fiscal policy in the United States, closed down, shut down, drama in Congress in terms of who leads it. You would say that we had a strong year fiscally in terms of enacting deficit reduction. Maybe that's what the bond market got the message more of than the rest of us did. So when you look at a fiscal debate in the next month, what is the biggest risk as you see it laying on the table now in this debate fiscally?
Yes, Congress will be coming back to a lot of unfinished business. So 2023 actually was quite a good year, despite countdown clocks all the time. Are we going to default? Are we going to shut down? Which is a terrible way to run the government. But overall, there was significant savings of well over $1 trillion from all the legislation that was passed. However, much of that is because so much of Congress's real work remained unfinished business. So when they return in January, they have huge issues to deal with, starting with, are they going to fund emergency funding for Israel and Ukraine, which I think the majority of members actually want, but there's still big hurdles on whether that will get done. Second, along with that, they've wanted to do big policy changes with the border. That will be both costly and policy changes. There's major disagreements over how to structure that deal, and that could stand in the way of everything. And then the biggest issue is they still haven't funded the government. We are 1/4 of the way through fiscal year 2024. Still, none of the spending levels have been determined. That is going to be a big deal in January and the beginning of February, and could, in fact, I don't want to start more countdown clocks, but there's the potential for a government shutdown if they can't come to agreement on those basic numbers.
And before we get to the shutdown and all the hand-wringing that will come to us in January, let's talk a little bit more about 2023, because reading over your notes, I mean, you make the point that the legislative and executive actions that were put in place this year so far would reduce the projected deficit by $1.3 trillion over the coming decade. I mean, you make the point that the policies that are being considered would undo that. But I think a lot of people would find that $1.3 trillion projection really surprising.
I think they would. That was never the political narrative of what was going on, because that savings got put in place amidst absolute chaos, basically around the need to lift the debt ceiling, and we should never be talking about defaulting. Congress ended up putting in the Fiscal Responsibility Act, which put in place savings on domestic discretionary spending that would affect both this year, next year, and then have savings for the following decade. If they stick to those levels, that will be the largest amount of savings we've seen in well over a decade. But because, one, the agreements were really not clear, you now have both sides kind of renegotiating them. And two, even though that was a great start, it only focused on domestic discretionary, which is the least problematic area of the budget in terms of growth. They didn't talk about Social Security. They didn't talk about Medicare. They didn't talk about defense savings. They didn't talk about the need for new revenues. So everything where the real structural problems are was still ignored because the fiscal savings that we really need to look at is politically difficult. And all you have to do is watch our budget process and see our politics is broken. We are unable to budget in responsible ways. So great year on paper. If we keep to that agreement, it could have a big, big difference in terms of getting us started on some needed savings. But we still have to do the hard work of budgeting to figure out where exactly those savings on these spending caps will be put in place in the actual budget. That's where things get tricky, and Congress may break down on that.
Maya, you know what's so funny? I'm listening to you, I'm thinking I could go back 5 years and we could have a very similar conversation, or go back 10 years. You have been following, the ins and outs of congressional spending and budgets here in the United States for a long time. You have this incredible perspective. As you look at this Congress, this government, where we are, the U.S. fiscal situation, what kind of grade would you give it, and why?
Yeah, that's a depressing question. As somebody who has been really focused on this issue for quite some time, it has been a steady decline. And the steady decline is an interplay between politics, governing, and our fiscal policy choices. And I think the point where we are so polarized as a country in a way that I think concerns so many of us, we are unable at this point to make decisions that are focused on the long term, focused on compromise, and actually do hard things. All of those are what you need to have fiscal deals that will keep the government debt under control. As a result, our debt has been growing not just during emergencies like COVID, when it should have, but during periods of strong economic growth, like leading up to COVID and since the pandemic has been over. So we now borrow for political expediency. That's the worst I've seen it. I mean, sorry, it's an F. We are failing on every count. We don't even pass budgets. There's a glimmer of hope, though, which is there are bipartisan members who are trying to start to work together. They're talking about a fiscal commission. They're talking about looking at all areas of the budget. We will see if we can get enough people kind of engaged in those realistic discussions. But I think a big switch was now fiscal policy, given what's going on in geopolitics, it's as much national security as it is economic policy. And that's starting to bring more people to the table. And I just hope that will enhance the discussion.
You see China doing it. We had some headlines this morning in terms of soybean buying, in terms of domestic security. And you're right, the pandemic taught us a lot. Long-term planning, I think, has always been something that people say the U.S. government needs to do more of. Having said that, how is the U.S. handicapped by its role on a global level that it prevents it from doing some of the things it needs to do domestically when it comes to spending and or cuts?
Well, that's right. So the U.S. has commitments that we've made around the world. Part of our national security policy is diplomacy and foreign aid. Those things are going to become more expensive if we stick to the same policies we have in the past. Very likely our defense budget is going to be growing even by a couple percentage points of GDP in the coming decade if things continue to be as risky as they appear to be. That squeezes out other areas of the budget. But quite frankly, the biggest part of our budget that is really putting pressure on the rest of it is the part that has to do with aging, healthcare costs, and these days, interest payments on the national debt. In just a few years, interest payments will actually be more than we spend on all of defense spending. So you have to look at the returns on these things. Some of these are long-term investments. It's not an issue that we can't do things. The issue is if we're going to do them, we have to pay for them. And the ongoing policy of borrowing for just about everything, that's what weakens the U.S.'s fiscal foundation so dangerously.
And maybe puts a little bit more pressure on the idea that we need to see rate cuts in this country faster and more quickly. As you say, the interest bill on the borrowing is pretty aggressive. Maya, thank you so much. Maya McGuinness, the Committee of Responsible Federal Budget. Thank you very much. And of course, there's two hot wars and the potential for one other in Taiwan. Conflict, escalation of tension. Let's not call it a hot war. And that puts that defense spending almost in a sacrosanct bucket and everything else is perhaps going to be much more vulnerable to the defense budget.
It's interesting politically here in the United States in terms of defense spending. We would think, okay, that's a Republican play. That's where they're going to allocate money. That is long gone. Whether it's Republicans in charge of Congress or in the White House or Democrats, the importance of protecting and playing on the global scale, it's important. You got to do defense spending.
And Manus, I thought you raised a good point. You think about this was one of the big consternations in the bond market over the summer, really, the deficit and, of course, Treasury issuance as well. And, of course, that has since fallen by the wayside. But for a while, it's all we talked about.
Some interesting stats there from our guest on it was a good year for fiscal prudence. Did anybody notice that?
She gave it an F, though.
She did. Nadia Martin-Wigan will join us next. For our audience worldwide, very good morning. It is Bloomberg Surveillance live on Bloomberg TV and Radio. Alongside me this morning, Carol Massar and Katie Greifeld. Very good morning. I'm Manus, Cranny. Snapshot of risk for you as you go into this holiday quiet period. You can almost kiss that record high on the S&P 500. You have, as one of our guests said this morning, weaponized FOMO. You're 0.5% away from a record high. Do you want to buy big cap, small cap, big box, little box for 2024? The consensus still seems to be Mag 7 can be resplendent. The Russell 2000, it could be time one of the best entry points since 2001 into the Russell 2000 on the small caps, catching up with value. Roll it over, have a look at the bonds. You couldn't give them away at 5%. They're gorging this morning globally across the world on bonds. Yields are dropping on 2 years. You've got an auction this evening. Let's see what the 5s and then the 7s do in terms of demand. You saw quite a healthy demand for 52-week bond, T-bills, I should say, yesterday. So there was a strong demand. Global bond market rally this morning as well. 30-year paper drops by just under 3 basis points. Roll it forward and have a look at the FX concoction. We've had EDNF man this morning where they're saying the dollar will remain resplendent, king, victorious, whatever word you'd like to choose next year. And that will define what you do with your commodities. So there's your euro dollar at the moment. The euro is up by 1/8 of 1%. The dollar down by 1/8 of 1%. Those are your markets. Let's set the agenda for you. Under surveillance. We have tensions. They are still high and on alert in the Red Sea. Continued attacks on container ships traveling through the area. Houthi rebels, backed by Iran, claim responsibility for a missile attack on a cargo ship. That was Tuesday. U.S. Central Command returning fire, shooting down 12 drones, plus a number of anti-ship and land attack missiles. The U.S. and other nations are forming a maritime task force to protect shipping in the Red Sea. And this is, this is part of the spook in the oil market that we had yesterday. But of course, we have evolved overnight. And we've just had a conversation this morning, which is these additional attacks from the Houthi rebels in Lebanon, or indeed the maritime attacks, are proxy wars on the United States and need to perhaps thought about differently to an escalation by Iran in the Israel-Hamas conflict.
And it's going to be interesting. I mean, just focusing on the Red Sea and that shipping route, whether you do see some of these big cargo ships start to transit that water under U.S. protection. We know that a few of those container lines plan to do that. It's going to be critical to see how that goes.
All right, yeah. I mean, it's once again that supply chain story. I know it's much more complicated, and when we're talking about lives at stake, but again, goes back to that story that really impacted the economy post-pandemic.
Well, something that will impact the economy for sure is AI. It impacted markets in an unprecedented way this year. So OpenAI, now they are enlisting the help of a former Apple veteran in order to create new devices. Outgoing Apple executive Tang Tan will join Johnny Ive's design firm, that's Loveform, with the ability to create new hardware. And that's going to be powered by Sam Altman's AI. Johnny Ive left Apple in 2019, but is famous for his work on the iMac, the iPhone, and the iPad while working for Steve Jobs. This is a big moment.
Those are two names. If you're like bookers out there or talent, you're like, go get those guests, because you want to know what they're up to.
Absolutely. I mean, this could be the year that we find that we get something in our hands
Yeah.
That is as sort of...
Maybe it's a chip that gets in our brain.
Carol.
Ways we can take this.
I'm going to go extreme for a moment.
I will say, I can't imagine that Apple is too pleased about this. Just quickly, I thought this stat was really interesting. Since 2019, about 14 members of Ive's former team at Apple have left. Only roughly a half of the dozen designers who once reported to him are still at Apple.
What you can say there is maybe it's a cathartic moment for Apple and gets them to get new blood in with new innovation, because the proposition, the accusation against Apple...
Or...
Carol wants to demolish the $4 trillion trade suggested by Mr. Ives yesterday.
But Johnny Ive's so important in terms of the look, the feel of the devices, right? So key in terms of creating that very valuable company today. So you got to watch these. Airbnb, Ferrari, Moncler. I mean, these are already people lining up to do business with them. Want to know what
there
they're
you go.
gonna do.
Your Ferrari that can do everything on its own. Let's talk about the shoppers. We're in full force. I've been out there, have you? But not at the same pace as last year. That's according to the MasterCard Spending Pulse. Retail sales rose by 3% from November to Christmas Eve, compared to 7.5% for the same time back in 2022. That was supposedly revenge spending. The data shows a shift away from bricks and mortar to online sales, rising over 6.3%. Katie Greifeld was online.
Say that again. What was I doing?
Online.
What were you? Oh, yeah. No, I was, because, I mean, you think
None of this
about
bricks and mortar stuff for you on Fifth Avenue, eh?
The convenience of Amazon is just hard to compete with. And for someone who hates shopping, hates being at the store, hates waiting in lines, they don't exist.
Don't like crowds.
Online.
Michelle Meyer over at MasterCard saying consumers were spending in a deliberate manner.
Were you deliberate in your expenditure?
I was actually very deliberate.
But you were helping other economies.
Did some travel, and that was kind of offset, spending on goods. I've got enough stuff. I'm getting rid of stuff. I don't need more stuff. Do you need more stuff?
No. Oh my gosh. You take a look at my apartment. I keep bugging my husband. Can we get rid of some of this?
What I will say...
the two of you are going to get calls now from those companies that come along and just sort of go, you two are like gifts.
I know.
You want to clear out your closets. Expensive clobber, I would say.
What I will say, what's important about that is I think about the consumer, so important to the U.S. economy, and how that will play into what we get from Fed activity. If the consumer slows down dramatically for some reasons, does the Fed start to act more quickly or more aggressively, right? We look for these softer metrics.
But look at house prices. They're just roaring ahead. I mean, again, roaring ahead even with mortgage rates
Doesn't
of 8%.
mean anything unless you want to get out of it and sell it. I'm just going to say. All right, let's switch gears a little bit, because we have an interesting conversation we want to share with everybody and talk a little bit more about it. And that has to do with former U.S. Commerce Secretary and PSP Partners Chairman Penny Pritzker. She says it is important to have diverse voices leading businesses. Earlier this year, Pritzker discussed starting the first female-owned real estate private equity firm 13 years ago. And she talked about a lot more. The David Rubenstein Show is where she was, peer-to-peer conversations.
It became really obvious to me that the semiconductors, we were going to have a problem in the United States with a shortage of semiconductors. Also that we were going to really run into a national security challenge, and because we were designing our semiconductors, but we weren't producing them. And so I galvanized the department to write a report to the administration and to the federal government about this. And that actually turned out to be the foundation of what became the CHIPS and Science Act. Avril Haines, who was head of DNI, and Ben Rhodes and others who were involved in the transition to the Biden administration, asked me about a number of things for advice. And I said, you've got to focus on the semiconductor challenge that we face. And so we did all kinds of things that have had a huge amount of impact. With such a diverse department, you get to be involved in a lot of different things.
So you now have PSP Partners, and you're making investments, and among other things, you're building real estate companies, and you're doing things with other women. In some cases, you built a company for real estate with another woman. Is it important to you to have women in business? Are you trying to be a role model, and have you tried to be a role model for women in the business world?
Well, I think it's really important to have diverse voices at the table. Absolutely, no matter what you're doing. And in business particularly, because, most consumers are women also. I have built 2 businesses in partnership with women. We started the first, this is unbelievable, 13 years ago. My partner Deb Harmon and I started the first woman-owned real estate private equity firm in the United States. It's hard to believe 13 years ago there wasn't one. Today, we compete a little bit with Carlyle. We're much smaller than Carlyle, but we compete sometimes with Carlyle. But we've built a real firm, and one of our ambitions with the firm, my partner Deb and I at the time, we'd each been more than 20 years in real estate. Real estate's a very male-dominated field. One of our missions was to be excellent and superb, to deliver great returns to our investors, but also to help diversify our industry.
All right, that was Penny Pritzker with David Rubenstein, former Commerce Secretary Penny Pritzker, of course, joining David on his show, Peer-to-Peer Conversations. Well, we want to talk a little bit more about diversity, inclusion, women in the workplace, and some of the challenges they continue to face. Kelsey Butler covers equality for Bloomberg. She joins us now on set. Good to have you here. Happy holidays. I feel like when it comes to women, the conversations, you and I have talked before, I know you've talked with a lot of folks here at Bloomberg, they continue to be the same that we had to some extent 5 years ago, 10 years ago. Why is it still so difficult when it comes to women in the workplace?
I think one major thing is childcare, and we really know that employers are missing the mark on this. When I was writing my most recent piece, I re-upped a statistic. Only 4% of employers provide any subsidized childcare for their workforce.
In the United States.
In the United States. And so when you think about that, most workplaces are not providing any kind of support. And I know some of our colleagues have talked about the fact that even the money you can put away pre-tax hasn't changed since the 80s. Older than most parents today.
That's because the cost of taking care of kids hasn't changed at all since the 80s.
It doesn't exist there. Can we talk about some numbers here, because you had such a great piece out this month on the cost of childcare. Walk us through some of the numbers and how that varies by region.
Yeah, so what's interesting is the prices have skyrocketed, up 32% according to Bank of America data since 2019. So if you're looking for full-time in-home infant care, that's about $40,000 a year across the U.S., but in some cities, New York, where we are right now, $45,000 a year. San Francisco, $56,000 a year. That's more than college tuition at this point.
I mean, and as you've reported, to really cope with those rising costs, you're increasingly seeing parents take on second jobs, take on side hustles. What kind of side hustles actually work? If you also have a full-time job, what can you actually do?
So I'm hearing a mix of things. The one story that really stuck in my mind was this woman. She works at an S&P 100 company, has a full-time corporate job, you know, the kind of position that any of us would think you'd be able to afford anything you need. She works part-time at a child care center, so she can get a discount on her kids' care. She saves $3,500 a month doing that. When you tally that up over the course of the year, that's a lot. Other people are doing things like driving for Lyft on the side, or you know, pulling double duty, working from home and also watching their kids
and then
at the same time.
not sleeping at night because there's no hours left.
That's just an extra, you know, it's an added thing to sleep. You don't really need it.
Yeah, no, it's pretty rough. It's a great read, and we highly recommend everybody head to Bloomberg.com or check it out on the Bloomberg terminal, because these are really, really difficult issues for a lot of families. Kelsey, thank you so much. Really appreciate it. Bloomberg's Kelsey Butler.
Okay, let's give you a quick snapshot of what's happening in markets. You have equities flat at the moment. One phrase we've been dealing with this morning is weaponized FOMO. Do you want to step into these markets? Is it fast money that has supported the rally over the past 9 weeks? Could we just be breaking trend ever so slightly at the moment? Bonds trade at 386. Let's see how the 5-year auction goes this evening. We have global CPI at the end of 2024 is 5.4%, down from 6.2% at the end of 2023. What is the next leg for global CPI? Those are the headline numbers as oil prevaricates in the mid-70s and takes a little bit of heat out of the rally that we saw yesterday on the attacks in the Red Sea. So the S&P 500 trades at 48.22. That is down 0.5%. Are we still full bull?
Quiet full bull.
expected, I think, after the run. And a lot of people may be just saying, I'm going to take the rest of the year off and we'll wait and see what the new year brings. As we already know, though, in a quiet week, we continue to focus on things overseas and really kind of trying to figure out how that will ultimately impact us in the new year. And I think there's a lot of questions still out there.
And of course, you think about what that means for markets, that the first order effect is in the energy markets, in the actual commodities
and
themselves.
Backing off even there a little bit this morning.
Even there, you are seeing that back off. And it's really been interesting to follow energy equities this year because the energy sector has been the winner for 2 years running. That streak is obviously breaking this year. Energy set to close the year down. And we're back to tech leadership. So there you go.
Yeah, well, we'll talk a little bit more about what's going on with the Bank of Japan.
FOMO.
Yeah, well, the other big risk for 2024 is what does the Bank of Japan do? They've already given themselves a little bit more latitude on the bonds that they can buy, so there's slight nuances going through there, and they can wait before they rip the Band-Aid off, according to the minutes from the Bank of Japan. Just think about that. Dollar-yen trades at 142.60. Up next, Steve Cook of CFR on the rising tensions and the geopolitical issues of the Middle East, right here on Bloomberg. For our audience worldwide, very good morning. It is Bloomberg Surveillance live on Bloomberg TV and Radio. Alongside me this morning, Carol Massar and Katie Greifeld. Very good morning. I'm Manus, Cranny. Snapshot of risk for you as you go into this holiday quiet period. You can almost kiss that record high on the S&P 500. You have, as one of our guests said this morning, weaponized FOMO. You're 0.5% away from a record high. Do you want to buy big cap, small cap, big box, little box for 2024? The consensus still seems to be Mag 7 can be resplendent. The Russell 2000, it could be time one of the best entry points since 2001 into the Russell 2000 on the small caps, catching up with value. Roll it over, have a look at the bonds. You couldn't give them away at 5%. They're gorging this morning globally across the world on bonds. Yields are dropping on 2 years. You've got an auction this evening. Let's see what the 5s and then the 7s do in terms of demand. You saw quite a healthy demand for 52-week bond, T-bills, I should say, yesterday. So there was a strong demand. Global bond market rally this morning as well. 30-year paper drops by just under 3 basis points. Roll it forward and have a look at the FX concoction. We've had EDNF Man this morning where they're saying the dollar will remain resplendent, king, victorious, whatever word you'd like to choose next year. And that will define what you do with your commodities. So there's your euro dollar. At the moment, the euro is up by 1/8 of 1%. The dollar down by 1/8 of 1%. Those are your markets. Let's set the agenda for you. Under surveillance. We have tensions. They are still high and on alert in the Red Sea. Continued attacks on container ships traveling through the area. Houthi rebels, backed by Iran, claim responsibility for a missile attack on a cargo ship. That was Tuesday. U.S. Central Command returning fire, shooting down 12 drones, plus a number of anti-ship and land attack missiles. The U.S. and other nations are forming a maritime task force to protect shipping in the Red Sea. And this is, this is part of the spook in the oil market that we had yesterday. But of course, we have evolved overnight. And we've just had a conversation this morning, which is these additional attacks from the Houthi rebels in Lebanon, or indeed the maritime attacks, are proxy wars on the United States and need to perhaps thought about differently to an escalation by Iran in the Israel-Hamas conflict.
And it's going to be interesting. I mean, just focusing on the Red Sea and that shipping route, whether you do see some of these big cargo ships start to transit that water under U.S. protection. We know that a few of those container lines plan to do that. It's going to be critical to see how that goes.
All right, yeah. I mean, it's once again that supply chain story. I know it's much more complicated, and when we're talking about lives at stake, but again, goes back to that story that really impacted the economy post-pandemic.
Well, something that will impact the economy for sure is AI. It impacted markets in an unprecedented way this year. So OpenAI, now they are enlisting the help of a former Apple veteran in order to create new devices. Outgoing Apple executive Tang Tan will join Johnny Ive's design firm, that's Loveform, with the ability to create new hardware. And that's going to be powered by Sam Altman's AI. Johnny Ive left Apple in 2019, but is famous for his work on the iMac, the iPhone, and the iPad while working for Steve Jobs. This is a big moment.
Those are two names. If you're like bookers out there or talent, you're like, go get those guests, because you want to know what they're up to.
Absolutely. I mean, this could be the year that we get something in our hands.
Yeah.
That is as sort of.
Maybe it's a chip that gets in our brain.
Carol.
Ways we can take this.
I'm going to go extreme for a moment.
I will say, I can't imagine that Apple is too pleased about this. Just quickly, I thought this stat was really interesting. Since 2019, about 14 members of Ive's former team at Apple have left. Only roughly a half of the dozen designers who once reported to him are still at Apple.
What you can say there is maybe it's a cathartic moment for Apple and gets them to get new blood in with new innovation, because the proposition, the accusation against Apple.
Or...
Carol wants to demolish the $4 trillion trade suggested by Mr. Ives yesterday.
But Johnny Ive's so important in terms of the look, the feel of the devices, right? So key in terms of creating that very valuable company today. So you got to watch these. Airbnb, Ferrari, Moncler. I mean, these are already people lining up to do business with them.
Mm-hmm.
Want to know what
there you go.
Do.
Your Ferrari that can do everything on its own. Let's talk about the shoppers. We're in full force. I've been out there. Have you? But not at the same pace as last year. That's according to the Mastercard Spending Pulse. Retail sales rose by 3% from November to Christmas Eve, compared to 7.5% for the same time back in 2022. That was supposedly revenge spending. The data shows a shift away from bricks and mortar to online sales, rising over 6.3%. Katie Greifeld was online.
Say that again. What was I doing?
Online.
What were you? Oh, yeah. No, I was, because, I mean, you think
None of this
about
bricks and mortar stuff for you on Fifth Avenue, eh?
The convenience of Amazon is just hard to compete with. And for someone who hates shopping, hates being at the store, hates waiting in lines, they don't exist.
Don't like crowds.
Online.
Michelle Meyer at Mastercard saying consumers were spending in a deliberate manner.
Were you deliberate in your expenditure?
I was actually very deliberate.
But you were helping other economies.
Did some travel, and that was kind of offset, spending on goods. I've got enough stuff. I'm getting rid of stuff. I don't need more stuff.
Mm-hmm.
Do you need more stuff?
No. Oh my gosh. You take a look at my apartment. I keep bugging my husband. Can we get rid of some of this?
What I will
say... the two of you are going to get calls now from those companies that come along and just sort of go, you two are like gifts.
I know.
You want to clear out your closets. Expensive clobber, I would say.
What I will say, what's important about that is I think about the consumer, so important to the U.S. economy, and how that will play into what we get from Fed activity. If the consumer slows down dramatically for some reasons, does the Fed start to act more quickly or more aggressively, right? We look for these softer metrics.
Well, look at house prices. They're just roaring ahead. I mean, again, roaring ahead even with mortgage rates
Doesn't
at 8%.
mean anything unless you want to get out of it and sell it. I'm just going to say. All right, let's switch gears a little bit, because we have an interesting conversation we want to share with everybody and talk a little bit more about it. And that has to do with former U.S. Commerce Secretary and PSP Partners Chairman Penny Pritzker. She says it is important to have diverse voices leading businesses. Earlier this year, Pritzker discussed starting the first female-owned real estate private equity firm 13 years ago. And she talked about a lot more. The David Rubenstein Show is where she was, peer-to-peer conversations.
It became really obvious to me that the semiconductors, we were going to have a problem in the United States with a shortage of semiconductors. Also that we were going to really run into a national security challenge, and because we were designing our semiconductors, but we weren't producing them. And so I galvanized the department to write a report to the administration and to the federal government about this. And that actually turned out to be the foundation of what became the CHIPS and Science Act. Avril Haines, who was head of DNI, and Ben Rhodes and others who were involved in the transition to the Biden administration, asked me about a number of things for advice. And I said, you've got to focus on the semiconductor challenge that we face. And so we did all kinds of things that have had a huge amount of impact. With such a diverse department, you get to be involved in a lot of different things.
So you now have PSP Partners, and you're making investments, and among other things, you're building real estate companies, and you're doing things with other women. In some cases, you built a company for real estate with another woman. Is it important to you to have women in business? Are you trying to be a role model, and have you tried to be a role model for women in the business world?
Well, I think it's really important to have diverse voices at the table. Absolutely, no matter what you're doing. And in business particularly, because most consumers are women also. I have built two businesses in partnership with women. We started the first, this is unbelievable, 13 years ago, my partner Deb Harmon and I started the first woman-owned real estate private equity firm in the United States. It's hard to believe 13 years ago there wasn't one. Today we compete a little bit with Carlyle. We're much smaller than Carlyle, but we compete sometimes with Carlyle. But we've built a real firm, and one of our ambitions with the firm, my partner Deb and I at the time, we'd each been more than 20 years in real estate. Real estate's a very male-dominated field. One of our missions was to be excellent and superb, to deliver great returns to our investors, but also to help diversify our industry.
All right, that was Penny Pritzker with David Rubenstein, former Commerce Secretary Penny Pritzker, of course, joining David on his show, Peer-to-Peer Conversations. Well, we want to talk a little bit more about diversity, inclusion, women in the workplace, and some of the challenges they continue to face. Kelsey Butler covers equality for Bloomberg. She joins us now on set. Good to have you here. Happy holidays. I feel like when it comes to women, the conversations, you and I have talked before, I know you've talked with a lot of folks here at Bloomberg, they continue to be the same that we had to some extent 5 years ago, 10 years ago. Why is it still so difficult when it comes to women in the workplace?
I think one major thing is childcare, and we really know that employers are missing the mark on this. When I was writing my most recent piece, I re-upped a statistic. Only 4% of employers provide any subsidized childcare for their workforce.
In the United States.
In the United States. And so when you think about that, most workplaces are not providing any kind of support. And I know some of our colleagues have talked about the fact that even the money you can put away pre-tax hasn't changed since the 80s. Older than most parents today.
Because the cost of taking care of kids hasn't changed at all since the 80s.
It doesn't exist there. Can we talk about some numbers here, because you had such a great piece out this month on the cost of childcare. Walk us through some of the numbers and how that varies by region.
Yeah, so what's interesting is the prices have skyrocketed, up 32% according to Bank of America data since 2019. So if you're looking for full-time in-home infant care, that's about $40,000 a year across the U.S., but in some cities, New York, where we are right now, $45,000 a year. San Francisco, $56,000 a year. That's more than college tuition at this point.
I mean, and as you've reported, to really cope with those rising costs, you're increasingly seeing parents take on second jobs, take on side hustles. What kind of side hustles actually work? If you also have a full-time job, what can you actually do?
So I'm hearing a mix of things. The one story that really stuck in my mind was this woman. She works at an S&P 100 company, has a full-time corporate job, you know, the kind of position that any of us would think you'd be able to afford anything you need. She works part-time at a child care center, so she can get a discount on her kids' care. She saves $3,500 a month doing that. When you tally that up over the course of the year, that's a lot. Other people are doing things like driving for Lyft on the side, or you know, pulling double duty, working from home and also watching their kids
at the same time. And then not sleeping at night because there's no hours left.
That's just an extra, you know, it's an added thing to sleep. You don't really need it.
Yeah, no, it's pretty rough. It's a great read, and we highly recommend everybody head to Bloomberg.com or check it out on the Bloomberg terminal, because these are really, really difficult issues for a lot of families. Kelsey, thank you so much. Really appreciate it. Bloomberg's Kelsey Butler.
Okay, let's give you a quick snapshot of what's happening in markets. You have equities flat at the moment. One phrase we've been dealing with this morning is weaponized FOMO. Do you want to step into these markets? Is it fast money that has supported the rally over the past 9 weeks? Could we just be breaking trend ever so slightly at the moment? Bonds trade at 386. Let's see how the 5-year auction goes this evening. We have global CPI at the end of 2024 is 5.4%, down from 6.2% at the end of 2023. What is the next leg for global CPI? Those are the headline numbers as oil prevaricates in the mid-70s and takes a little bit of heat out of the rally that we saw yesterday on the attacks in the Red Sea. So the S&P 500 trades at 48.22. That is down 0.5%. Are we still full bull?
Quiet full bull.
expected, I think, after the run. And a lot of people may be just saying, I'm going to take the rest of the year off and we'll wait and see what the new year brings. As we already know, though, in a quiet week, we continue to focus on things overseas and really kind of trying to figure out how that will ultimately impact us in the new year. And I think there's a lot of questions still out there.
And of course, you think about what that means for markets, that the first order effect is in the energy markets, in the actual commodities
and
themselves.
Backing off even there a little bit this morning.
Even there, you are seeing that back off. And it's really been interesting to follow energy equities this year because the energy sector has been the winner for 2 years running. That streak is obviously breaking this year. Energy set to close the year down. And we're back to tech leadership. So there you go.
Yeah, well, we'll talk a little bit more about what's going on with the Bank of Japan.
FOMO.
Yeah, well, the other big risk for 2024 is what does the Bank of Japan do? They've already given themselves a little bit more latitude on the bonds that they can buy, so there's slight nuances going through there, and they can wait before they rip the Band-Aid off, according to the minutes from the Bank of Japan. Just think about that. Dollar-yen trades at 142.60. Up next, Steve Cook of CFR on the rising tensions and the geopolitical issues of the Middle East right here on Bloomberg.
If Powell's really going to cut 6 or 7 times over the next 12 months, it's probably because there's something beyond just inflation cooling off. As we get into 2024, I think we are that positioning mismatch is going to be largely behind us. We're not going to normalize to 2019, nor should we. We're normalizing to something else, but the big shock and awe are behind us.
The big shock and awe is behind us. Michael Purvis, the Tall Balkan Capital Advisors, the founder and the CEO. How do we look for risk at this time? It's just gone 7:46 a.m. here in New York. Flat on the S&P 500, 48.32.23 is where we are. The euro dollar, again, fairly phlegmatic, which is a flavor of the week, a word that I think describes the week. Bond markets did well last night on the very short-dated auction. 52-week auction was 52-week T-bills was well received. We got 5-year paper and 7-year paper over today and tomorrow. Let's see how that goes. And oil gives back 0.6% after rallying nearly 3% yesterday on those attacks in the Red Sea. So at the moment, according to ED&F Man, it is the trajectory of the dollar will define where we go next with the oil market. And according to ED&F Man, oil looks cheap at the moment. It's $75.
On that, the shipping giant Hapag-Lloyd, this is one of our most read stories on the Bloomberg in the past 60 minutes, saying it will keep its vessels away from the Red Sea even after the launch of that U.S.-led task force to protect the key route from militant attacks. It's basically, they're just saying it's still too dangerous. So again, you see a shift in how companies have to do business, and this would, one assume, lead to higher costs, right?
And you wonder how well equipped these companies are to do those shifts at this point. Of course, it's not that as if the flow of goods is actually stopping. It's just rerouting. And you think about the experience with the pandemic, maybe some of these big cargo container lines are better equipped than they would have been a couple of years ago.
But as they say, as they reroute, they're going to go around the Cape of Good Hope, and that's a detour of several thousand miles. It's a very different route, and that brings a whole different cost equation.
Changes the cost of carriage, changes the cost of storage, and you still have rates at over 5%. And floating oil, by the way, storage there is up over the past couple of weeks as well. So there's a whole host of tentacles in this story.
That route in the Red Sea, 12% of global trade goes through that. So if you want to look for, a significant statistic and impact potentially. So this is why it's on our radar, and that's why we want to get to our next guest. Stephen A. Cook, he's Senior Fellow for Middle East and Africa Studies at the Council on Foreign Relations, and he is watching this situation, writing about it. I think we interrupted you this morning. Stephen, thank you for taking some time out, because this is certainly sounds like it's top of mind for you. How are you assessing the current situation in the Middle East as it feels like it is escalating?
It's certainly, the risk is there for a very significant escalation. And the Houthis, who are the ones responsible for attacking shipping in the Red Sea, are the primary actor. At the outset of the war in Gaza, everybody looked north toward Hezbollah, another Iranian proxy. But really, the group that has been most engaged in both threatening Israel with its missiles and drones, as well as the Red Sea, have been the Houthis, clearly at Iranian direction. So I think that there is a very, very significant risk of escalation there. The American announcement of a task force to protect shipping is a good thing. It may not, however, necessarily ward off the Houthis.
Well, Steve, we had a conversation this morning with Wendy Schiller, and the debate is this: these proxies, these escalation in the proxies, whether it's Hezbollah in Lebanon or the Houthi rebels in the Red Sea, is a proxy war which is much more directed against the United States, perhaps, than the direct conflict of Hamas and Israel. To what extent is there a point at which Iran will still keep some constraint on their proxies? Have they got full control of their proxies? Are they the absolute controller of what happens? Do you still think Iran is ultimately the arbiter of escalation with the proxies?
Well, there's really a range of autonomy for these groups. Hamas, for example, is relatively more autonomous than Hezbollah or the Houthis. Certainly, when it comes to the Houthis' threats to shipping in the Red Sea, the Iranians have a major hand to play in it. In fact, there were reports that the Iranians were directing the Houthis through the use of their own technology to attack certain ships and pick targets for them. So as long as the Iran issue remains unaddressed and their ability to arm and finance these groups, we're going to be contending with these problems. And as you pointed out, 12% of global trade goes through the Red Sea. This is a major way in which Egypt, an extremely important country, earns hard currency. There are all kinds of economic and geopolitical implications of allowing the Houthis and their Iranian patrons to menace the global economy this way.
And Stephen, when it comes to the Red Sea, Bloomberg has reported in the past couple of weeks that the U.S. is considering strikes on some of these Houthi bases. And when you think about how this could play out, what would tip the U.S. strategy from deterrence to actually going on the offense here?
Well, it seems at this point that the Biden administration is satisfied with setting up a task force. I think that what would trip the United States into direct action against the Houthis would be an attack on American warship itself. There is precedent for the United States protecting shipping. Way back in the late 1980s, the United States reflagged Kuwaiti oil tankers to protect them from Iranian attacks during the Iran-Iraq War. But that also came along in parallel with direct U.S. military action against Iranian forces to prevent them from even threatening shipping. That doesn't seem to be the case with this task force. I think the United States wants to remain actually on the defensive here, unless, of course, American forces come under direct fire.
Well, that's what I want to talk about. I mean, do you think that this task force will be enough to be that strong enough deterrence that would keep this contained to just acting on the defense?
No. In short, there are already American warships in the Red Sea that have taken action to defend against Houthi attacks, yet the attacks keep coming. It strikes me that an important part of deterrence is also the willingness to use military force to establish rules of the road. And thus far, the United States has shied away from doing that for fear of widening the conflict. But the Houthis and the Iranians and Hezbollah seem determined to incrementally widen this conflict. I think with the United States on the defensive and merely reacting to the Houthis is asking for more trouble.
So does the U.S. need to be more on the offensive in some regard, more so than it is? And I say that just a headline crossing. And this is on Twitter, X, whatever you'd like to call it. This is from Barack Ravid. He's a political reporter from Axios. And he says Secretary of State Tony Blinken expected to travel to the Middle East late next week to talk about the Gaza war. 5 U.S., Israeli, and Arab officials were telling him this. Blinken planning to visit Israel, the West Bank, Jordan, the UAE, Saudi Arabia, and Qatar. That's a pretty big trip. And that sounds like they've got some plans or hopes for some plans to maybe bring, I don't know, to maybe move this forward in some regard. How do you read that? And what does the U.S.'s role need to be, maybe in a more aggressive fashion or more not so defensive, but much more on the offensive?
Well, certainly Secretary Blinken has taken the lead in American diplomatic efforts to stabilize the region and accelerate Israel's war against Hamas in order to bring it to an end and to plan for the day after. When it comes to the Red Sea, this is really something for the Department of Defense. And it strikes me that the United States does need to take more action against the Houthis. Otherwise, once again, shipping in the Red Sea will come under threat. And we'll be living with this situation and the consequences of it for some time.
Hey, Stephen, before we go, 20 seconds. What's your headline going to be on your story? What should it be, you think?
I don't write the headlines, but it should be precisely what I just said. The United States needs to go on the offensive.
All right, going to leave it there. Hey, thank you so much. I know busy morning for you, and so appreciate you stepping out to give us a few minutes there. Stephen A. Cook, he is, of course, of the Council on Foreign Relations, joining us here on Surveillance.
Well, it certainly has not carried through from yesterday on the oil market, but it's very prescient that he says there needs to be much more aggressive, let's say, pushback against those Houthi rebels. The oil market has given back 0.6%. Yesterday, we rallied just under 3%. So the war premium, one can say, over the past 5 days on the market board at the moment is 6%. Is that enough of a move higher to allow for the geopolitical risks that are now very present in the Red Sea?
I think it's kind of interesting. I thought about the conversations we had this morning as we're trying to make sense of the headlines. So escalation, what's going on, like the timeline of everything is a little complicated. And I think we're all trying to assess it. And maybe that's why the markets, at least on the energy side, crude specifically, take a little bit of a breather to figure out, okay, now what's next?
I think they do.
Yeah, and Manus, I like the point you made earlier that doesn't look like much of a war premium that's priced into the oil markets right now. Maybe we're just back to that supply story once again. I know we're going to keep talking about it.
We talked about that earlier. It's not just the war, right? It's the idea of what kind of supply measures are out there or production measures are out there that really play into that price.
And that's certainly what ED&F Man says. So let's put that question to Nadia Martin-Wiggin. She joins us from Svelland Capital to talk about her outlook for the oil market with geopolitics at play. OPEC Plus negotiating their way through voluntary cuts and quotas and exit from Angola from OPEC Plus. We'll talk about that and more with Nadia.
Maybe the Fed is going to be friendlier in 2024 from an interest rate perspective.
I think the Fed is in a tough position because the soft data has led you blind this year.
It's hard to justify rate cuts at this point in time.
If data comes out that's really awful, that we're heading into some type of a recession, a bigger recession, then maybe you get a cut earlier than that.
If 7 cuts is really coming, then I'm not going to be so bullish on equities.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Yes, indeed, everybody. We're talking a lot about the Fed. We're talking about rate cuts, how many, how aggressive. We're also talking about recession. But having said that, the most read story on the Bloomberg in the past 60 minutes, don't cheat. What do you think it is?
I couldn't even begin to tell
Houthi
you.
rebels.
Apple Watch saga set in motion by late night email to Tim Cook. That is our most read story on the Bloomberg.
I haven't even clicked on that one yet.
Yeah,
have you got an Apple Watch?
I do. Actually, I'm waiting.
Wearables?
I have one. I'm waiting to buy a new one.
This is a Garmin, actually. I hadn't caved to the Apple Watch.
The alternative. But the issue is, of course,
I can't buy it right now.
What happens with these wearables, with this lawsuit, because there's nobody coming to save Apple just at the moment at the top.
They're reworking some stuff. They're going to send it back to the government, and then the U.S. government, trade has to say, okay, that's all right, or not,
and
into
maybe
early
we'll
January.
get that in January. Interesting that they just don't want to pursue any sort of settlement with Massimo. At least that's Massimo's perspective. But there's many different ways this could go. But for right now, they are not selling these watches.
The only certainty, there's a lot of lawyers at work right now. All right, having said that, a very good morning, everybody. It is Wednesday, December 27th. This is Bloomberg Surveillance. As you know, Tom, John, and Lisa are off. I'm Carol Massar, along with Manus, Cranny, and, of course, Katie Greifeld. Quick check on the markets. Really quiet on the equity side of things, although we're waiting to see when the opening bell kicks off at 9:30 here in New York, whether or not we get a new record on the S&P 500. We are a whisper away from it, but right now we're pretty flat. What?
This feels like the most boring all-time high for the S&P 500.
Make it exciting. Your job is to make that board light up like a Christmas tree.
Do you want to go back to what, the 90s or like 2000 when it was like, the hats came out?
That would be great if we could make some hats, maybe get some tattoos. But I'm just saying, if we get it this week and we get it on a day where the S&P 500 is up like 0.1%.
Who's going to notice?
It feels a little anticlimactic, all I'm going to say.
I think the best line we've had all morning is not the weaponized FOMO, but is they couldn't give bonds away at 5%.
I do like that.
I think that's actually brilliant.
Yeah.
They couldn't give bonds away at 5%. But yeah, there you go. There's the S&P 500.
Now they're attractive?
Now, if you haven't got them in the portfolio, you run the risk of serious misstep.
If you hated them at 5%, you'll love them at 3.9.
You got to love those bonds.
Wait, you want
global
logic in
bonds.
terms of
A
the
global
trade?
bond market rally is in chain this morning. UK rates, German rates, and US rates all coming lower. I think the Europeans are just paying the catch-up. They had an extra day's holiday, Carol.
Yeah, I know. You guys, man, everybody, I want that extra holiday.
Boxing Day.
Call it anything you want.
I celebrate it, you know? Anyway.
All right, having said that, there's a lot, we're kind of thinking about big, broad strokes, especially when it comes to 2024, and especially when it comes to the energy space as we watch what's going on in the Middle East, concerns about that escalation. We've heard a lot on that in terms of what could potentially come in 2024. Nadia Wiggin is director of Surveillance Capital and joining us to talk a little bit about the trade in energy and more this morning. Nadia, we are seeing oil prices back off a little bit after that 2.8% run up yesterday. How are you thinking about the energy trade against the Middle Eastern backdrop?
Good morning. I think what we saw with yesterday's move is that the market has been positioned in quite a short way. It has been short ever since the OPEC announcement came out with poor communication. And we now see that as we have the U.S., actually launching into Iraq, that risk premium is starting to come back to the forefront of thinking. But we're not at the highs we've seen before. I'd say on where we are right now, maybe up to $82 is possible. We are cautiously optimistic about the energy complex as we start 2024 overall.
So how do you think about levels? We all remember a much more expensive barrel of oil years ago. I'm looking at back in 2022, we hit about 91 a barrel. So I'm just thinking about how do you think about the price action? Do you feel comfortable putting a level out there for maybe 2024, at least the early part of the year?
Well, I think at the start, what the market really wants to see, and is something you mentioned, is, we have the supply side story coming from the US, and the market wants to see inventory draws start to come. And prior to this escalation and possible rerouting of things through Suez and avoiding the Red Sea, we saw big builds coming in January, right? Now it's looking more flattish, and we'll start to see draws in February and March. And that's where we can start to see that build up in crude prices. However, what we saw in September is we hit a ceiling at $95 a barrel in terms of the futures market. The physical market was trading at above $100 a barrel, but especially with the strength of the US dollar, we saw that, India, China, they were pulling back from buying. We had a backup of West African crude from Angola that we haven't seen since COVID in terms of unsold barrels waiting to load. And so I think that, the kinds of levels that we saw, X having, just the complete shutdown of things in the Middle East, we're not going to see that kind of February pricing March like we saw initially when Russia invaded Ukraine.
Nadia, good morning. You're cautiously optimistic. They must be happy over at the White House because they're able to fill up the SPR. We're sub $80. But you raised the specter, and I think this is a very interesting point. Much criticism of the price cap that was pushed by the Americans. You think that will come back on the slate in 2024 and that they will push for tighter sanctions and perhaps a lower cap. Now, just run me through where you think that falls.
Yeah, I think they might not necessarily lower the cap of $60 a barrel, but they will enforce the cap, right? So especially when we dip down into the 60s on WTI, that really gave a green light to the Biden administration that we're at comfortable levels in terms of the oil price. And, they said they would initially buy at $69 a barrel. Then they told the Saudis, right before the invasion of Israel by Hamas that, 79 is okay. So they're in that comfortable range. I think that if we were to see crude, back up in the 90s, then that will create a stress again on the Biden administration. But what we've seen is they're starting to go after these tankers. We're seeing things being backed up in terms of deliveries, especially into India, because the cost of freight and shipping is going higher. And we reach these difficulties. And this also happened in September, that, you start to have that complete cost come together for a refiner, and it hits their margins. And in this latest crude move that we've seen yesterday, we saw $2 come off the refinery margin. If they then have to spend tons more on the freight costs, then that becomes problematic, right? So that is where I think it will be a potentially more effective price cap. But, until we get too high.
Well, isn't the truth of it that they need to turn the screws and be a little bit more judicious in how they treat Iranian oil, which they have been quite louche, if the reporting is to be significantly believed. They've been easy on Iranian crude. U.S. crude is pumping like billio. So the supply side and the discretion on sanctions on Iran, are going to come to bear as well in 2024, aren't they?
I think so. We've seen 650,000 barrels per day of production growth in Iran this year. We actually see upside of 150,000 barrels per day potentially next year if the Iranians go for it. But of course, they can start to tighten that. But I think the Biden administration has been very nervous about doing that and doing that for Russia as well, because the IEA and all the agencies have been talking since the war in Ukraine began that we're going to lose 1 million barrels per day of Russian oil any moment, right? Now they've finally given up and the market is thinking, okay, we'll get 200, 300,000 barrels per day, less crude in or less exports in the first quarter. But it's still big numbers if the U.S. were really to go after both of those countries.
Can I just say, I'm kind of like blown as I'm hearing like the levels of production and more production and like whatever happened to like alternative fuels and the discussions around that.
It's definitely not in this conversation, I'll say that.
No.
But I want to keep the conversation going on production and specifically talk about U.S. production, because U.S. shale production obviously been on fire this year. Just to go through some of these numbers, Nadia, this time last year, the U.S. government forecasting domestic production would average $12.5 million of barrels a day in this current quarter. But in recent days, that estimate was bumped to 13.3 million. That difference is the equivalent of adding a new Venezuela to global supplies. You think about this fantastic growth that we've seen in U.S. shale. Do you think that momentum will continue?
I think there's a seasonality, right? So in the first half of the year, and especially the first 3-4 months, we will probably see that momentum slow down, even flatten. They're even forecasting a dip, the EIA, which we're a bit skeptical about because, the market is doing well. We've seen energy stocks start to come back now when you look at their pricing, and all these M&A deals are being viewed positively, right? But there is this seasonality, and you tend to have this pickup in the second half of the year. That is when you see those numbers. And historically, the EIA has had to revise up that production figure by 600,000 barrels per day by year end. So when we look towards next year, the forecasts are for around 400,000 barrels per day production growth. And typically, that's a very low number. You either see it decline in production or you see it increase, more like 600, 800, 1.1 million barrels per day. So I think we'll see this slowing in the first part of the year, which will give strength, I think, and support to the market. It will then help OPEC think about bringing back some production, especially in the second half of the year when they expect demand to pick up, depending on the interest rate situation in the U.S. But then they need to be careful because you have this catch up. And I think what the market really got wrong this year is we didn't see rig counts come up, right? Yeah. We've had 3-mile laterals. They're talking about 4-mile laterals in the shale patch. And this is something that now the market is aware that this can happen. So they're going to be watching it. So they're not going to be expecting, 50 rigs to come up every month in order to have this supply coming forward. We'll be much more aware of it, I think, and prepared.
All right, Nadia, 20 seconds, though. It sounds like you're saying that U.S. shale production and OPEC, they will get closer to the same page.
Absolutely. They want to support a market, I think, long term. And then this is where the shale producers, they still talk about capital discipline and giving money to shareholders, but they're actually doing a lot in terms of activity and production. So they are trying to find that happy balancing point. And, when we think about global trade and how things work, it's good for America's energy security. It's also good for shipping because you then have this alternate route that, of course, can be much longer if you're going all the way to Asia, especially if you have to miss Suez. But, going to Europe, we also have that level of production to replace Russia.
All right. Good to know, and some good macro thoughts when it comes to certainly the energy markets. Nadia, thank you so much. Nadia Martin-Wiggin of Civilian Capital joining us on a day when we see crude a little bit lower in today's trade. Having said that, little movement, though, when it comes to S&P 500 futures. They are flat, just down about 0.03%. which is kind of interesting because, or not interesting, because we've been saying from the get-go yesterday when we started on air that it's going to be a quiet week, everyone. Certainly we're talking a lot about what's going on in the Middle East, but for the equity markets, a little mellow, to say the least.
I have an exciting fun fact.
What?
She's dangerous with a fact.
I'm so excited. What do you have?
I put it out into the X world that it would be so poetic if we got a day where the S&P 500 moved 0.00%. Someone points out the last time that happened was January 10th, 2017, and it's only happened about 10 times since 1980. Social media really delivered this time.
Thank you very much. You trust it?
I don't.
Did you check your sources?
Go back and fact check. Don't quote me on that, though. Of course, I just say it on television. But it's been a while since we saw one of those.
You throw these facts out there, it gets dangerous. The question is, will semiconductors do 100% as they did this year? And that, and with the you've got all of the momentum for this AI explosion. So who's going to win that war? What's it going to mean for the chip makers in Europe, in Asia? Semiconductors 108% up this year. That was the triumph.
NVIDIA up 237% alone.
Mm-hmm.
I just hope the pension fund advisors got NVIDIA in that pension fund.
My brother reminds me, I was in it years ago. I was reading articles and they were talking about this chip company.
Is he still in it?
He's, I think,
Does your brother manage money? Does he want a job?
He's a contractor. All right, coming up, Anna Ashton, China expert at Eurasia Group. That's next.
China is suffering from the 4 Ds, right? Lack of demand, the de-risking that the U.S. and China are involved in, bad demographics, and heavy debt. The fiscal policy on the part of the Chinese is one where they just have an aversion toward putting support into the household and into the private sector. And instead, they want to shift emphasis onto the public sector. And that's one of China's key problems.
All right, that was Billy Milken, Institute Chief Economist, speaking to us earlier this month here on Bloomberg. A very good morning, everyone. We continue on this Wednesday. Quick check on the markets, if we may. A little quiet. We've been telling you this all morning. S&P 500 futures. Will Katie get her wish? S&P 500 futures, now up 0.4%.
Getting farther away.
I'm going to sing All I Want for Christmas in a moment.
All I Want for Christmas.
She's looking for unchanged.
Totally flat day.
All right, New York crude, as we continue to watch news out of the Middle East, down about 1.6%. So a different trend in terms of what we saw in yesterday's trade. One market, guys, that didn't do so well in 2023, MSCI China Index, down 17% this year if you look in dollar terms, gauged to the lowest level since 98 against the MSCI Emerging Markets ex-China Index. You kept talking about that yesterday.
Oh, yeah.
Back at China, emerging markets, very different story.
But that's the big Goldman's theory, which was, you bet on this, on the whole sort of BRICS narrative. In actual fact, when you look at China, it has dragged that whole narrative lower. So you've got to strip it out. You've got to look at it EM, excluding China, and it depends what you believe in, whether it's the common prosperity trade or not. Mm-hmm. And it didn't flash hot this year, for sure.
An interesting phrase that I heard in the past couple of weeks is the concept of unbundling EM. Okay, you have to take out China. You have to look not just at EM as a block, as a mishmash of countries, but you really need to go country by country in this period that we're entering into.
I think about China, too. It's like this crazy growth stock, if you will. But how long can you be a growth stock before you start to become a much more mature country? And you're going to grow differently. Your economy changes. It transforms.
And we talked about this a little bit yesterday, that as an investor, okay, maybe you can pick out China. If you're a company doing business globally, you really can't ignore China.
Well, of course, the other side of this coin is what happens with central bank policy. So the PBOC, will they cut rates next year? And many other emerging market central banks were much further ahead than the developed nations in terms of their rate hiking cycle. They were far right, they were far in front, and EM is much better equipped than perhaps G10.
All right, put this all in a cup and we give it to Anna Ashton, who's our next guest. She's Director of China Corporate Affairs and U.S.-China at Eurasia Group. Anna, great to have you here. China, every day, there's always something coming out here. President Xi making some comments about their economy and how it needs to be perceived going forward. Industrial production numbers that came out this morning showing improvement in the month of November, but still down if you look at where they were a year ago. How do you see China right now, and how should we as investors be thinking about China?
Well, industrial production is key from Beijing's perspective. That's, really sort of central to how they're hoping to shift their growth model moving forward. They really want to be focused on building up strategic industries and dominating those industries. And of course, they also have to get consumption more robust, but there's not a clear path to that in the near term. And for that reason, I think one of the key things to think about in 2024 is how China's relationships with the U.S. and other Western trading partners will evolve. And although there are lots of reasons why there could be less stability than we've seen in recent months, the fact that China doesn't have an easy way forward to get its economy back on track means that they're going to continue to be more inclined to have a stable foreign policy with the United States.
Anna, we've seen a great deal of theater. Anthony Blinken, Janet Yellen. We saw Xi here with Biden, the press conference. You can make of that as what you will on Biden's response about what kind of person he thinks Xi really is. But the reality is next year, Taiwan has an election, and Taiwan could come up as a much higher piquant point in this political landscape than any of us are talking about at the moment. So you say it's going to get difficult. Is it around Taiwan, or should I look for other issues?
It could certainly be around Taiwan. We're expecting that the election in January is going to be, a source of turbulence for U.S.-China relations. And that's because more than likely the candidate that is currently the vice president and Democratic Party candidate, or Democratic Progressive Party candidate, who is the most forward-leaning on Taiwan independence, more than likely he, William Lai, will win the election. And Beijing is incredibly nervous about William Lai leading Taiwan for the next possibly 10 years. Therefore, there's likely to be a reaction from Beijing, a show of force, an increased show of force compared to what's been done in previous months, and also some economic measures. That will also prompt a response from Washington, which will be calls to be more clear about support for Taiwan.
We'll bring that to some of the news that we got last week, that apparently Xi Jinping at that APEC summit in San Francisco in recent weeks told Joe Biden that there are plans to reunify with Taiwan. How new was that, though? How different is that from what Xi has been saying publicly over the last couple of years?
I think that's the key. It's not really new. It's exactly the same thing that he's been saying. It's consistent with China's longstanding position on Taiwan that there ultimately needs to be reunification. The fact that it was conveyed personally, I think, it's noteworthy that this came up in their personal conversations and that it wasn't reported before is interesting. But I don't think that there's anything significant or different about the message. And lots of other senior Chinese officials have repeatedly said this publicly, emphatically, in the past couple of years.
And Anna, of course, we're having this conversation as we have a hot war, of course, underway in the Middle East and attacks going on in the Red Sea. And in those situations, we really haven't heard much from China. China hasn't been involved up to this point, at least in a very public fashion. Is that China's MO here?
It's always been China's MO, modern China's MO, to sort of avoid being deeply involved in international conflicts, but that's changed somewhat in recent years as China has become a much more significant power on the world stage. And I think that we see China trying to navigate that most specifically in the context of Russia-Ukraine, with Russia being a close ally, but Europe being an incredibly important trading partner. I wouldn't be surprised if China takes a more sort of forward-leaning and upfront position on conflicts going forward, but there's no upside for China to wading into the Middle East conflicts right now beyond what it's done so far, which is to try to say that civilian deaths need to be avoided and that the conflict needs to be resolved.
Anna, one thing I wonder as we wrap up here, the maturation, if you will, of China, right? Kind of emerging growth, moving into a much more kind of developed economy on a lot of different levels. Having said that, does that mean in its pursuit or changes that it's at the cost of something like its relationship with the United States? I mean, how do we need to be thinking about that?
How do we need to be thinking about China as a more developed market?
Yeah, and just are they willing to do it at all costs and in terms of their relationship with like the United States?
I think that depends a lot on the United States, actually. I think China wants to be able to have a functional relationship with the United States, a functional economic relationship in particular. But China also has its own domestic goals and ambitions. And there's this reality that the United States views China as a major strategic competitor at best. And to the extent that that erodes China's ability to pursue its own goals, China's going to be looking for ways to double down on its own separate plans for pursuing those goals, with or without United States trade and investment.
And that would argue that
that's long term.
And that would argue that one makes a global economy, right? That the U.S. is very competitive with other countries as well. Anna, thanks so much. Anna Ashton of Eurasia Group joining us here on this Wednesday, right? I think about that. We are so critical. Obviously, they're not apples to apples in terms of the government and how things are run, China versus the United States. But, the U.S. is a very competitive nature as well.
Yeah, I mean, the fight for foreign direct investment, if you look at the narrative within China, the whole economic policy for next year, whether you define China is turning the corner, can hit 5% growth, is whether they can draw in the FDI, which is flooded out. Capital has exited China at a phenomenal pace. FDI is at a 4-year low. And unless that turns, it's going to be harder and harder to keep the 5% goal alive.
And of course, that comes back to confidence in Beijing's policy, the stability of Beijing's policy. We saw that with the gaming news over this past week.
Coming up next, we're talking ETFs. And we are back on Bloomberg Surveillance. Quick check on the markets. Very quiet day, another quiet day. Let's bring it up for you. S&P 500 futures. Katie, sorry, but it's now up 0.7%.
No, we're building in the pre-market.
Up 3.5 points, 48.28. Quick check in terms of, yes. Let's take a look at what's going on in the Treasury world, fixed income specifically. Watching, I just think about the year that was, 10-year at 384 when people were talking about, 6%?
Oh, yeah.
On that 10-year. It's a very, very different tone here in terms of where we're ending up the year.
Yeah, and we've got a global bond market rally. German government bonds are, yields are down 7 basis points there. In the UK, you're looking at government bonds at the short end down by 6 basis points. So again, that global bond euphoria or that fear of not being part of this bond market rally is really, really kicking in as Europe comes back in and dovetails what we saw at the end of last week in the United States.
Important to remind everybody it's a global bond story. And a quick check on the currency market, if we may. This on a day where Jeffries is saying the yen rally looks fragile as a lot of money managers are piling in. Having said that, let's take a look at the euro-dollar cross. You can see just up a little bit. 110 is what we're looking at in terms of the trade. So a little bit of change there. All right, let's get to some of the headlines we're watching for you. Under surveillance this morning, tensions in the Red Sea pressuring the oil market with prices near 1-month highs. Houthi rebels backed by Iran claimed responsibility for a missile attack on a cargo ship on Tuesday, yesterday. The U.S. and other nations are forming a maritime task force to protect shipping in the Red Sea. Maersk is looking to resume routes in the area with new protections in place, but everybody watching it very closely. On the corporate front, Apple appealing a ban on some of its smartwatches after the White House failed to veto a measure by the U.S. International Trade Commission. The tech giant is in a dispute over its blood oxygen sensor with Massimo. The ITC sided with Massimo in October, saying Apple violated 2 patents. Apple is looking to resume sales of the Series 9 and Ultra 2 devices, saying a software update can resolve the issue. We will see in early January. And then an LA office building sold for 52% less than its price just 5 years ago. Harbor Associates and F&F Capital Group bought the 5-story property for just under $45 million. It sold for $92.5 million back in 2018. Talk about a different property market. And last week, the third tallest office tower in LA sold 45% below its 2014 price. It's not just location. It's just we are using office property very differently, everybody.
Yeah.
Some major banks around the world have increased their foot space. They've stepped back. You just think of HSBC making major changes in terms of where they are in their London property portfolio. But I mean, that is what you call a haircut and a half. $92.5 million to $44.7 million.
On sale,
Who's
I'll buy
holding the
two.
debt? Actually, the
Yes,
question you want to ask
exactly.
yourself, this story is just a much bigger conversation around next year. Who is holding the debt in commercial real estate? Who's the most exposed? Where's the biggest leverage? And that is going to be the critical issue, I think, in 2024.
Well, it's funny. I feel like I've had a few conversations just over the past couple of weeks about commercial real estate debt, about CRE, and I've spoken to a few people who are pretty bullish on the prospects, though, but then they say, wait, we're not talking about office here. You know, we're talking about different types of CRE. You think about offices specifically, still in a very murky world, and still the future, too, very murky.
I keep feeling like this is one shoe that, are we just waiting for it to drop?
You're just scarred from 2008 like I am. CDS is squared.
I don't want to be stupid here. I mean, I just want to make sure. And I just do wonder, is it just a case of timing in terms of when debt comes true? Or, you know, we've seen some big, well-known established players in the real estate, commercial real estate space, office property space, you know, kind of walk away or have some troubles. And so if they're having difficulties, what does it mean for some of those lesser players? I don't know.
And to focus on this specific office building in Los Angeles, some details here. It was constructed in 1987. It's had more than $11 million in renovations. And I don't know if we have a
just
photo.
a couple of bathrooms and some new tiles.
Exactly. And it looks like it's, you know, a lot of glass. It's very shiny. So we're not talking about, you know, a shack here.
The producer of this show will be keenly interested in that. Amy's always got a vantage point out there in terms of the refurb, the refit. She's always in the market for something new and shiny.
Harbor principal June Choi saying, after several years of kicking the can down the road, we are now beginning to see distress hit the market.
Here we go. So maybe that will be one of the big stories that we're following in 2024. But let's get now to one of my favorite topics, and that's the world of ETFs having another banner year in 2023. Looking ahead to 2024, we're going to do that now with Eric Balchunas. He is senior ETF analyst for Bloomberg Intelligence. He's my co-anchor on ETF IQ, which is, of course, Mondays at 1 p.m. on Bloomberg Television. Eric, great to see you. Happy almost New Year. Before we get to 2024, let's talk about 2023, because I could tell you my biggest topics this year when it comes to active, et cetera, launches, closures. But what really stuck out to you as the theme of 2023?
It's a toss-up. I'd say it's a tie between the T-bill and chill trade. So a lot of money went to Treasury ETFs and money market mutual funds, by the way, which grew by $1 trillion. So money market mutual funds alone took in double what ETFs took in. So that made everything work much harder for your money. So equities, there was a 6-month drought of any cash coming into the equity ETFs until, I don't know, about the midsummer period when people's FOMO got too bad. We call it the FOMO drought. They finally piled back into equities. But that was a really interesting play because you can now get 5% in a basically risk-free money market mutual fund. The other one I would have to say is the rise of active. Active ETFs accounted for 25% of all the net flows this year. And wait for it, 80% of every new ETF launch this year was active. I live and breathe this stuff, and I could not have predicted it would be that big. And that really, the new launches especially, that's a little bit of a foreshadow into what we can expect in the future. So I do think when you look at that number, though, a lot of the active money was money coming over from mutual funds, so it wasn't exactly new money, or target-oriented active, like the buffer ETFs or covered call strategies. So the stock picker active still struggling a bit, but there is room for this new evolution on active for sure.
And that's something that you and I have talked about, that those active flows, they're actually going to pretty passive-like products. But I want to rewind to the point that you made, that you have seen a lot of money come into short-dated debt ETFs, of course, that continuing. But it's really interesting to see just hordes and hordes of money coming into relatively expensive money market mutual funds. They hold pretty much the same thing as these short-dated ETFs, but they're more expensive. That hasn't really deterred the flow of traffic, though. Still a lot of money going to those relatively expensive mutual funds.
Yeah, no, this was a big deal for Wall Street because a short-term Treasury ETF charges like 15 basis points or lower. Some are below 5, right? So it's dirt cheap, as we say. A money market mutual fund typically is between 20 and 50 basis points. So we're talking 4 or 5 times the cost. So this was actually a big boon for Wall Street. JP Morgan, Fidelity, the big winners in particular. Vanguard's money market fund is dirt cheap, but the rest are a little on the higher side. Probably because people have a platform or an advisor and they use the same brand. So they're less picky when it comes to money market mutual funds. But it's interesting, too, the average money market mutual fund has $22 billion in assets, whereas the average Treasury ETF has $1 billion. So usually when you see that high of an asset per product ratio, there's a bunch of supply that would follow. But we haven't really seen a new money market fund ETFs mutual funds being issued. I have heard rumblings that people are going to try their best to put the money market concept into an ETF in the coming year, although it would be impossible to do with a fixed NAV. They'd have to have a floating NAV. But I think, again, where there's cash, there's a will, and where there's a will, there's a way.
Well, with those kind of numbers around, Eric, it sort of raises the spectrum of where is the risk if something breaks. But I want to focus on the small cap, because you've come up with a staggering stat. The Pacer US small cap cash cows 100 ETF defied physics and delivered a 35% return. I thought on this show we've been debating the laggardness of small caps and the underperformance there, but this is pretty amazing.
I think so, too. That means this ETF, CAF, went out and chose a group of small caps that was able to not only double IWM, which is the Russell 2000, but also beat the S&P. Amazing. So it's proof that there were pockets of winners. What was the factor? The answer is quality. This thing looks for cash flow and cash flow yield, and that usually correlates with quality. And we know that in large caps, the quality factor was the best one. So if you were in the quality area anywhere this year, you probably did way better than the index. And so this thing I won because of that. Now, next year, when we talk about all these areas catching up, which is one of our big themes to look out for, is the left behind areas catching up, like small caps. Will this thing still have room to run? I mean, we'll see. But the money flowing into this is extraordinary. 44 straight months of inflows. That is incredible for a Pacers kind of indie-ish ETF that was was in oblivion for 3 or 4 years. So this is, if there's a feel-good indie breakthrough hit of the year, it's CAF.
Yeah, there's a great chart that you shared with us, and for those on radio, when it comes to small cap cash flow or cow ETF, the flow kind of moving along and then all of a sudden shooting up. And I do wonder about, Eric, we talk about this with certainly the FANG stocks or the Magnificent Seven, this kind of FOMO and momentum trade that just builds. Is that what you're kind of getting to, the concern that this is what this could become rather than a fundamental play?
Oh, yeah. So when you see flows like that's when what we call a grassroots craze. ARKK had the same flows, oblivion for 5 years and then bam. And you start to see this sort of imperfect pattern that builds over, say, a year or two. At some point, the soccer ball gets kicked to a different part of the field. And this thing will start underperforming, of course. Anything outside of beta is going to have its moment and then not have its moment. So I do think, though, when you think of small caps, you think of there's some junky stocks in there. And what's a way to, de-junk your small cap is to look at cash flow. So I do think the thesis on this is pretty solid. Relative to, say, something like really high growth that might be, or a theme ETF. But still, let's face it, if it starts to underperform the Russell 2000 in particular over a year or two, some of this money will come out.
All right, Eric, it's always great to talk to you. We didn't even get to spot Bitcoin ETFs, but we're going to have to save that conversation for next year. Eric Balchunas of Bloomberg Intelligence, thank you so much. Happy New Year. And what a great place to end, because coming up tomorrow at 7:30 a.m. Eastern, we have Cathie Wood, the founder and the CEO of ARK Investments. She will be joining us for a nice chunk of time. And Carol, her performance this year has been pretty impressive, to say the least. And
nobody gets people going either for or against when you bring up Cathie Wood and ARK. We've talked to her an awful lot of times. That fund, ARK Innovation, up 72% year to date, still down 65% from that all-time high back in February 12th of 2020. We knew there was such a run-up. But nonetheless, she's certainly somebody that we always want to watch in terms of what she's buying or selling. So we have a lot of questions also about some of her play or recent interest overseas, if you will.
Yeah, let's see what she's got to say about Japan. Everybody has been so enthusiastic about Japan. Why she made her most recent additional purchase and what is their thinking behind that. But of course, the Bitcoin ETF will be an interesting conversation.
On our minds right now, will the S&P 500 hit a new record today? We will see. But if you're just joining the program, S&P 500 futures, they are little change, just up about a point, or a gain of about 0.03%. And so we will see if we get a new record. I do feel like this could be a day where traders just want to get it over the mark, be done with it, and then move back.
They just want to give Katie Greifeld that red headline, which is you've got a record high for the S&P 500. But global stocks are lagging the S&P 500. And this is going to be part of what we debate in the first quarter and indeed next year, which is to what extent does the United States remain King US, or that sort of splendid isolation in terms of investment relative to the rest of the world, which is 4.5% behind on a record high. MSCI All World 4.5% away from its all-time record high.
Well, it comes back to big tech, right? You think about the U.S. tech sector really powering all of the benchmark indexes here higher. That tech sector just doesn't exist in Europe. And to the point that we're on record watch for the S&P 500, the NASDAQ 100, the big tech index, it's already got there. You know, that was a story a few weeks ago. And it's the S&P 500 that's the holdout.
I mean, what Europe does have is they have a huge exposure in terms of the chips. And the chips with 100% performer in the S&P 500. And on a relative basis, that's where they've got the tech exposure. Not to the same quality, perhaps in the same size. Technology is still the lead in Europe this morning as well.
I just love when everybody poo-poos the growth stories, the technology. I'm like, our whole world is technology.
There's a world beyond the United States of America, ladies.
Yes, indeed. And
tech was up 32% in the U.S., which is under the U.S.
2 versus 1. There it goes. No, we're going to continue, everybody. Coming up, Sel Hardy, research analyst at CFRA, with her 2024 outlook for healthcare stocks. Got to talk about that sector as well. A lot going on when it comes to M&A. This is Bloomberg.
Really, the last 2 months defined 2023 markets. Powell did a 180 from his tone in September to November. I don't think that next year is going to be that meaningful as it relates to everything relied to the Fed. I think fundamentals going to matter more. Economic data is going to matter more. And I think the Fed is in a tough position because the soft data has led you blind this year.
All right, talking a little bit about Fed policy and what we might get in 2024. That was Matt Niskin of John Hancock Investment Management. Having said that, quick check on your backdrop on this Wednesday morning. And you've got futures, little change. S&P 500 futures, we are wondering, could we get a new all-time high on the S&P 500? The number to watch once trade resumes, 47.96.56. Right now, futures just up about 2.5 points. Call it little change, a little bit higher. It's not unchanged, Katie Greifeld.
But it's close.
Close but no cigar, as they say. 10-year note, quick check on that, a little bit lower, 384 in terms of the yield. Having said that, something we haven't talked about, but there was a lot of activity this year, you guys, is the healthcare sector. Whether we were talking about the new class of weight loss drugs. Yes. I did not pursue, but yes. But I mean, we did talk about it in that way, but I feel like sometimes it gets lost in all the high-tech stuff. But there was a fair amount of deal activity and news coming out this year.
Yeah, we have seen some M&A there. The expectation is we could see more of it. And to your point on the overall market, of course, we have seen Eli Lilly. We've seen Novo Nordisk have great 2023s. But the sector overall, first back-to-back loss in about 2 decades, which really tells you something that, okay, it was real feast and famine for some of the actual names in that sector.
Really good point. Biotech, though, if you take a look, up about 22% in the past 3 months. So enjoying some of that recent rally that we've seen more broadly.
Yep. And there's deals in the making. Bristol out there spending $4 billion on Raise Bio. So again, is 2024 going to be a year of consolidation? Is this a year that Eli Lilly catches up with Novo Nordisk?
Everybody checking their pipeline and saying it's not just about COVID drugs, folks. Let's get to it with Sel Hardy, research analyst over at CFRA. Sel, good to have you here. Healthcare, talk about it. We gave you some of the big macro backdrop, but it does feel like there's some stuff going on. Look back at 2023. Are there trends that we saw that you assume will kind of carry over into 2024?
Yeah, hi. Thanks for having me.
Good morning.
So we think 2023 was a difficult year for the healthcare sector. We saw some weakness and volatility and significant variances in terms of performances across companies. And despite its defensive nature, the sector overall has been weaker compared to the other sectors since the beginning of the year. The S&P 500 healthcare index was down by 0.7% year to date, which compares to the S&P 500's remarkable performance of nearly 24% gain during the same period. But leaving this behind, we expect 2024 to be the year of gradual recovery, especially for biopharma. Our chief investment strategist expects a rotation from 2023's worst performers to 2024's best performers, and the sold-off healthcare sub-industries such as pharmaceuticals and biotechnology relative to the overall market should offer nice buying opportunities at current valuations.
So we need to, as it were, segregate the healthcare market discerningly, perhaps in the same way as when people say, let's buy tech. You need to be a little bit more discerning. Just take us a little bit further into that narrative about how we segregate out the winners and the losers. We spend a lot of time talking about weight loss drugs and where they go. Those are the big blockbusters. Eli Lilly up 56% on the year. You got Novo Nordisk up 47% year to date. So if you take me beyond borders and a little bit deeper, where can I achieve a similar return in perhaps a more diversified field?
So when we look at the performance of the 10 sub-industries individually within the healthcare sector during 2023, we noticed there are different essentially performances. For example, healthcare supplies, healthcare facilities, and healthcare distributors were the clear best performers year to date. On the other hand, healthcare services, healthcare technology, and life science tools services were the worst performers. So overall, we expect improved revenue performance throughout 2024 as the comparison base gets easier versus 2023. As you may know, a number of companies within the healthcare sector continue to face year-on-year tough comparisons due to sharp declines in COVID-19 related revenues. So along with the anticipated margin improvement driven by ongoing cost initiatives taken throughout 2023, I think gradual recovery should be in the cards. Also, our technical analysis team at Lowry Research, a CFRA business, thinks that certain healthcare sub-industries are showing positive trend patterns, such as the beaten down healthcare services.
So let's zoom out. Let's talk about the sector overall, and let's talk about some of these weight loss drugs, because that's really been all anyone has wanted to talk about for the past couple months or so. So like we mentioned at the top, I mean, you've seen certain companies just have runaway years, especially when you think about the likes of Novo Nordisk overseas, Eli Lilly over here. But it's been interesting that it seems like that's dragging down the rest of the sector. When you think about the disruption and the Ozempic effect, if you want to call it that. I know that that's specific to one company, but the Ozempic effect on some of the other companies in the healthcare sector.
So we think that essentially Eli Lilly will continue to become a more valuable company during 2024. We'll continue to ride the hype around the GLP-1 interest. So essentially, we are still very bullish on Eli Lilly, which generates more than half of its revenue from its diabetes drug portfolio. But it's also very well diversified in other therapy areas such as cardiovascular, immunology, neuroscience, and oncology. We think oncology is still a very big area and it will remain the largest therapy area in biopharma, generating strong sales during 2024. Within our coverage, we think Merck and Eli Lilly are the best positioned companies with their key oncology franchises.
It's interesting to hear you say that. I come back to a call from BMO earlier this month, basically raising Amgen to outperform on its obesity drug potential. Their reasoning came back down to valuation, that basically you think about the promise of Amgen's pipeline. Of course, it doesn't really match what Eli Lilly has on the market right now, but basically Eli Lilly is trading at such a premium. It's time to look at maybe some of the less expensive options, if you want to call them that. When you're thinking about analyzing Eli Lilly and the like, how much are you taking valuation into account?
Oh, absolutely. We take valuation seriously, but we think that essentially there's still a good rally potentially for Eli Lilly through 2024 because we see several catalysts. It's not just the diabetes portfolio, but we think the company has really solid medium to long-term growth prospects. It has a diversified portfolio of strong brands. It's focused on innovation. We have seen several new product launches. Eli Lilly is also big on recent acquisitions. And the company has a strong balance sheet, which is a key differentiator. We think the near-term late-stage therapies development will be important. For example, for Alzheimer's disease, donanemab will be a key development this year. And for tirzepatide, we think we may be seeing other approvals for other indications, which are going to be important.
We saw another headline yesterday, Bristol Myers coming out to putting a $4 billion offer on the table for Raise Bio. What is it that justifies in pharma a mega merger? I don't know whether we can put $4 billion in the category of mega merger, but what do you expect for next year? What is it that justifies doing deals in 2024? Are we going to see more bolt-on acquisitions like this, or is it going to be a year of something significant?
So for biopharmaceutical companies, deals can be as important for growth as scientific discoveries, as they can really help companies struggling to grow internally. We have seen an increasing number of biopharma companies turning to M&A this year for innovation and increase their revenues by augmenting their pipelines or entering new therapeutic areas. So we think for 2024, we are going to see a similar level of activities. But at the same time, we're also seeing some antitrust risk on the rise. For example, we're seeing the Federal Trade Commission to be taking a more active stance on antitrust review. However, we think this is not stopping the large companies to look for large deals because they really need to invest and focus on innovation.
Yeah, no, that's always right. So it has to be forefront in terms of future growth for these companies. Sel Hardy, thank you so much. Sel Hardy of CFRA joining us to talk about the healthcare sector. And you're right, Manus, you make a really good point. Like when we talk about tech, there's just so many different moving parts and aspects of technology. Same thing when it comes to the healthcare space, whether it's biotech, big pharma, you know, the technology side of the space. It's a lot of different players.
There is a world beyond the Mag 7. And I think when we looked at that small cap story, I think that's where you begin to understand. Actually, you can have active fund managers or active ETFs which search for quality growth. But again, it's the same narrative in tech, which is quality, balance sheets and cash and the ability to deliver. And that's going to be the hallmark of 2024.
But of course, the tough thing for those active managers, you take a look at the S&P 500. I know that you've been able to outperform in pockets of small caps, but what, 23, 24% rally? It's hard to say no.
Just want to mention a headline. The Michigan Supreme Court rejecting an attempt to remove former President Donald Trump from the 2024 ballot based on the U.S. Constitution's insurrectionist ban. So that contracts with what we got from the ruling from the Colorado Supreme Court. All right, coming up next, everybody, Zach Griffiths, senior investment grade strategist at Credit Sites. That's coming up next, right here on Surveillance. This is Bloomberg.
Maybe the Fed is going to be friendlier in 2024 from an interest rate perspective.
I think the Fed is in a tough position because the soft data has led you blind this year.
It's hard to justify rate cuts at this point in time.
If data comes out that's really awful, that we're heading into some type of a recession, a bigger recession, then maybe you get a cut earlier than that.
If 7 cuts is really coming, then I'm not going to be so bullish on equities.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, a very good morning. This is Bloomberg Surveillance, live on Bloomberg TV and Radio, alongside Massar and Katie Greifeld. A very good morning. I'm Manus, Cranny. So here we are, ladies. We can smell the potential for a red headline, which is a record high. In the U.S., will that remain 0.5% away from a record high? Globally, we're 4.5% away.
Will that headline come across?
I can smell the weekend. I can smell a record.
What does it smell like, Manus?
It smells rich, 24%, and full bull for 2024.
Nice oaky smell there. We'll see if we get it. Of course, it has been a slow climb on the S&P 500 to get to that closing high. I believe it's just under 4,800. We are a whisker away, a breath away, a hair away, whatever you want to call it. We're very close.
4796.56.
There you go.
I'm a little obsessed. January 3rd, 2022, so that would be almost 2 years ago.
It would be kind of cool if we made it 2 years without.
Could we wait till January 3rd? Could we wait till the new year? And
That's true.
I think the other thing that we got to consider is there is a global bond rally at play. So there is a world beyond the U.S. Treasury, perhaps not in the same size and heft, but we are seeing a tailwind. Are you
smacking down the U.S. chicks here?
No. I haven't got the passport yet. I haven't even got the green card yet. So right now we're on
it's the U.S. government calling, Manus. Sorry.
No, but you know what? Maybe you can make a little bit more money outside the U.S. than
Absolutely.
Here. But it was hard to do.
People have been saying that for years now.
And the economy, what are going to be the fundamentals?
What is this? The American sort of advance.
Not only is it Americans, it's the Jersey girls going up against you.
From a very specific spot.
It's all right. Where I come from, it's fighting Irish as well. Bond markets around the world are really got a lovely tailwind. German bonds are down by 7 basis points this morning. The UK, tailwind as well, down 7 basis points.
You keep us honest. We love it.
The question is this. Who's going to cop the most and who's going to cut first out of G3. That is the presumption of the markets. That's why you have this fantastic phrase that we had this morning, which was weaponized FOMO from Steve Solznick. That was the very, very core of what he's saying. There's weaponized FOMO in the bond market and the equity market.
Who's going to cut first, or who has to cut first because their economic fundamentals are coming undone?
Stagnation nation.
Is that a different
in the
conversation?
US. No, I think you're quite right. It's, who's going to be bounced into having to cut first. You've got stagnation nation in the United Kingdom, and you've got slowdown all the way around Europe.
And you think about who is going to be dragged there, to your point. Maybe it's the ECB. I think you think back rather to that trio of central bank decisions we got, the Fed, the BOE, the ECB. Christine Lagarde, it's felt like she tried her best to be hawkish. Of course, the market reaction went the other way, but she was pretty adamant, especially compared to what we got from Jerome Powell, basically playing up everyone's dovish fantasies.
Listen, he pivoted so hard and so fast in the space of 2 weeks. I mean, I just got to wait and see what the Fed speak is. It's a bit like going out clubbing with me.
It was time. He's data dependent. The data told him one thing.
Did we get a lot in 2 weeks?
Okay, Jersey girls, let's just leave it. Let's just leave it there. I think we're going to get some IBs on that. Let's bring in Zach Griffiths. He's the senior investment grade strategist at Credit Sites. Do not mess with these women on this set this morning. They're playing hard and fast. We've talked about this effusiveness, this ebullience in markets, in equity markets, in bond markets. In the credit world, you would say spreads are the tightest since 2021. High grade isn't cheap, but it's more a bet on rates than it is on credit worthiness. So with that in mind, is this tight spread narrative completely predicated on the presumption of 150 basis points of cuts next year?
I don't think it's completely predicated on it. It's certainly fueled the incremental tightening we've seen over the past couple of weeks, I'd say. And so when we look ahead to 2024, we are expecting the Fed to cut first. We've been in the March 2024 rate cut camp since early October, actually, and that was a much more difficult message to deliver to clients at the time. The data up to that point had not quite indicated the same type of disinflation we've seen over the past couple of months. And so now we have almost 150 basis points of rate cuts priced in. We're thinking about 100 basis points of rate cuts is more appropriate with that first in March and then every other meeting thereafter. We are thinking the Fed can go before the ECB and Bank of England, but it's going to come down to, like you were just discussing, does the Eurozone economy fall into recession, and is the ECB forced to cut? That's not our call. Right now, we think the Fed goes first and even goes a little bit more than both of those other major central banks.
Zach, so we're talking about the Fed. Let's talk about how that bleeds into the IG credit market, because you take a look at spreads right now at just about 100 basis points with the potential to tighten further from here. But where's that tightening coming from? Is that just predication of what the Fed is going to do, that rate rally that could follow, or is that actually improving corporate fundamentals getting priced in?
We're expecting fundamentals to remain sturdy, maybe come under a little bit of manageable pressure. And when we think about what is going to drive any incremental tightening from here, we think it's the technical tailwind of central banks normalizing monetary policy, and all of this cash that is still stored at the front end of the curve in these money market mutual funds starts to move out both the credit and duration curve. And so we think that that can be an incremental spread narrowing move. And we think it happens in the first couple months of the year. We think you probably have seen some of it already. And once we get into election season and are starting to think about the fiscal picture, all of this treasury supply, perhaps there are some bumps in the road, and our year-end spread target for investment grade credit is 100 basis points. So very little incremental tightening from where we are today. When we came out with the view in early December, there was a little bit more spread tightening to get to that 100 basis points, but we've seen some of it already. So some of this technical tailwind that we expect in early 2024 perhaps has already played out at the end of this year.
Yeah, we are just about at 100 basis points right now. And I want to go cross asset here, because a lot of people might look at 100 basis points on investment grade spreads and say, that looks pretty expensive here. That looks fully priced. But you write in your notes that actually credit looks cheap to equities. Walk us through that.
Yeah, Katie, if you just look at the earnings yield on the S&P 500 and compare it to the yield to worst on the investment grade credit index, it's about as cheap as it's been over the past 15 years, really going back to dynamics we haven't seen since prior to the financial crisis. So when we consider where all of this cash on the front end could go, looking at a relative value perspective between equities and credit, we think that high quality fixed income looks pretty good relative to large cap equities. So just looking at the S&P 500, and we think that even extends to high yield credit, comparing that to perhaps small stocks is the more appropriate way. It also looks a little bit cheap relative to, let's say, the past 15 years. And so we do think that it's a more attractive opportunity to go into fixed income with just much better carry than we were used to in the prior cycle when yields were so low.
You know, one thing I wanted to ask you, Zach, our John Authors came out with a column a couple of weeks ago, and he said everyone's a lender now and just, addressing the growth of credit markets. And he talks about the growth being too rapid, flaws in credit markets sparked a global seizure. He reminds us about the 2008 financial crisis, and then doesn't matter. That was kind of a bump in the road, and we just saw the rise of credit just kind of take off. Having said that, and it's not just, traditional lenders, you've got the private markets. So what do we need to be kind of watching out? What are the flaws that we might be missing in the credit markets?
We're really not seeing much in terms of flaws. I think one thing that we highlight as a key risk to our clients is just thinking about overall supply of fixed income in 2024. A lot of that is really coming from the Treasury market as we look for nearly 1.9 trillion of Treasury coupon supply for the market to take down. And so when you kind of couple that with the investment grade market, we're looking for about 1.3 trillion of gross supply, again, in 2024, more or less matching what we saw this year. So thinking about just the immense amount of fixed income coming to the market for the market to digest, I think that's really what we've highlighted as a potential headwind to spreads and yields in 2024. Just kind of looking at the consensus, there really isn't much of a call for yields to rise back to around 5% on the 10-year. And so perhaps that's an underappreciated risk. It seems like the narrative from the late summer into early fall has kind of calmed down in terms of fiscal concern and all of that supply. But the actual technical headwind of all that supply coming to market, that's something we're keeping an eye on throughout 2024.
Yeah, the IMF reminding us global public debt tripling since the mid-1970s, now 92% of the world's combined GDP. So that by the end of 2022, that was kind of their benchmark in terms of measuring. All right, so new money to put to work. Zach, where do we put it right now?
We're overweight investment grade and high yield credit in the U.S. And so we think that both of those are attractive opportunities. When we think about the carry offered on investment grade above 5%, around 8% on high yield, that still looks very attractive. And when we think about the balance of risk between credit risk and duration risk, perhaps we're a little bit more comfortable taking that duration risk now than we would have been even a couple months ago when you had that momentum trade higher in yields. And the big thing that when we go back and look at historical trends, even though we do have heavy supply coming down the pipeline in 2024, the bigger driver of the duration move has been a shift in monetary policy and economic conditions. And so we think this policy normalization that we see and slowing in the economy is going to be a boon for the duration trade in 2024.
A boon for the duration trade. Zach, very briefly, in less than a minute, leveraged loans issuance is up 18% this year. Are there going to be big opportunities there? And if so, where?
So we do see a little bit more supply in leveraged loans in 2024, but we have a more balanced risk approach. So we have a market weight allocation to leveraged loans, as from a risk-adjusted perspective, we don't see returns as quite as attractive as we see in high yield, especially just considering the lower rated nature of the leveraged loan market. And so we do prefer high yield bonds to leveraged loans in 2024. You saw outperformance over the past couple of years of that asset class. We think that that ends in 2024.
And of course, that high yield call is all going to come down to the level of defaults that you have. And you've penciled in 3.5% for the year 2024, which seems reasonable given the returns that you're putting out on the map. Zach, thank you so much. Zach Griffiths at Credit Insights. So you're right, Katie, it is about the cross-asset allocation and how those spreads behave. And those spreads are, to a certain extent, tightened up a lot on on rate cuts, perhaps a little bit trumping the credit worthiness. That's where we started the conversation.
And it was interesting to hear him go back to money market mutual funds. It feels like almost every conversation comes back there. Where is that cash going to migrate out of when it does come off the sidelines?
Well, that was the FOMO drought that we had in the last conversation. In other words, we hit the wall of that FOMO drought of the money from the S&P 500. Let's just have a little look at some of the markets. The S&P 500, 48.24, unchanged.
There we go. We did it.
You got what you wanted.
Ain't over yet.
That's true. Okay.
It ain't over yet. I mean, look at Euro's trading higher, up 0.3%.
See what you did?
Rats.
Yes, you Jersey girls are dangerous. That's the conclusion. There you go. 383 is where we are on Treasuries, ticking down ever so slightly in yield. And again, the one narrative that came through the morning is very much, and I like the way Steve Selznick set up the agenda, which was you couldn't give this paper away. You couldn't give bonds away at 5%. There was the turmoil, the emotional turmoil. Jamie Dimon sitting on the stage talking about 6%, 7% potential in rates. Remember those days? You remember you come in and you had that big billboard with Jamie Dimon? He didn't say that we were going to get 7%
We had
rates.
guests who came on who talked about the same thing, 6%. And for a while, it really felt like that's where we were going because the pressure was to the upside in terms of rates in that 10-year.
And again, you think about the narratives that got us there over the summer to finally break above 5%. What were we talking about? We were talking about big Treasury issuance. We were talking about U.S. deficits, et cetera. I forgot what else. Oh,
the refunding. It was all about the refunding. I mean, we had BMO. I was here. I think it was around the first week of the war, and Ian Lingham was here from BMO, and he was talking about the potential in terms of the Treasury's funding requirement. How much would that be? How much could the bond market absorb? Would there be a form of indigestion?
Japan, and whether we were going to have foreign buyers come in and take up our debt.
We need a massive whiteboard because there's just all these, like just the idea of issuance too. Like these are things that are going to play out in terms of ultimately the kind of rate environment and market environment and investment environment we get.
Well, the other headline is from the Bank of Japan in the past 24 hours, which is they feel that they've got a little bit more time before they need to rip the Band-Aid off of negative rates and really make a material adjustment to YCC. Jared Cassidy joins us next from RBC.
There are unexpected events in every year, and so whether it's the regional banking crisis early on in the year, or whether it was another, the Hamas attack on Israel on October 7th, whether it was escalation, the continuation in Ukraine, whether it's the tensions in China, these are all things that happen, and they go on all the time. But what we look at is what goes on in our core customer base. Overall, it's been a decent year, and the economy's grown, unemployment stayed low, and the bank's done very well.
That was Brian Moynihan, Bank of America CEO, speaking with the Bloomberg team earlier this month on the state of U.S. banking. A very good morning to you. U.S. banking, what's the story, ladies? It is, if it didn't have J.P. Morgan in the title, it just wasn't a bank worth talking about, really. On track for the biggest annual profit in American history. So let's start that conversation.
Good to be J.P. Morgan and Jamie Dimon, it feels like.
Yeah, right? I mean,
like everything they touch.
You think about what happened in March and what was one of the outcomes of it. J.P. Morgan got bigger.
Absolutely. Right. And can anybody beat Jamie Dimon and JP Morgan? This is state of play on the markets. We're flat on the S&P 500. Technically, we're down 0.3%. Katie, I know that you like to be precise.
Well, we'll get there.
Euro
Market's
dollar.
Not even open.
The euro dollar, I mean, what drives euro dollar? It's who cuts first and fastest. I've said that through the morning. Bonds at 384 is where we are at the moment, and you need to load up on your bonds. That's been one narrative that has come through the morning. We have this weaponized FOMO for equity and bond markets. Crude gives back 0.5%. Rallied nearly 3% yesterday on the heightened tensions in the Red Sea with attacks from the Houthi rebels. But let's talk a little bit more about banking, because is there anybody really that can beat JP Morgan? Let's start there. It is Jared Cassidy, head of US Bank Equity Strategy and large cap bank analyst at RBC Capital Markets. He saved the U.S. banking system. Jamie Dimon did. That was in.
Wait, is this 08 you're talking about? Oh no, I'm sorry.
Again. No, he was all right. He was all right for a few years. Of course, we're talking about Jamie Dimon, JP Morgan, First Republic, Jared Cassidy. Good morning to you. Is there anybody can catch up to JP Morgan? Are they invincible? Everybody has a little bit of a risk with them. Talk me through your JP Morgan call. Good morning.
Good morning, Manus. This year has been a great year for the J.P. Morgan shareholders and stock price, led by Jamie Dimon. As you pointed out, the company is going to put up some very, very strong net income numbers this year. And it's really been a flight to safety for many investors. Earlier in the year, we remembered what happened in March with the Silicon Valley signature failures. Then, of course, in May with the First Republic failure. And many long-only investors were quite shaken by those events. And as a result, they went into safety, and safety was JP Morgan. That has started to change, however, Manus. We've noticed it in the last 4 to 5 weeks. Risk on is now taking precedence over risk off. JP Morgan is still doing well, but now you're starting to see some of the other banks that people were more nervous about. Bank of America, for example, with their unrealized bond losses in their held to maturity portfolio. That doesn't seem to be as much of an issue today. The stock has recovered nicely since the lows in October.
Gerard, that's exactly where I wanted to go, because you shared with us a lineup of lists, or rather of names of banks that you would want to invest in, I guess, or own. You suggest investors should own. JP Morgan isn't on that list.
What we suggest is for 2024, we really want to go risk on. And if there is an investor that is still concerned about the outlook for the U.S. economy or concerns about maybe the banking system, then certainly owning a JP Morgan is the way to go. But we don't see that. We see in 2024 the economy doing a soft landing, if you will. We see the Fed being finished with raising short-term interest rates. And if we're right on that call, this is shaping up possibly to be very similar to 1995, which when you compare it to 1994, it was an awful year for banks. Everybody was worried about what was going on. The Fed raised rates from 3 to 6% from February of 94 to February of 95. And the hard landing never came in 95, and the stocks were up 55%. So soft landing, terminal rate being reached is very positive for risk-on banks in 2024.
Let me throw some numbers out for our radio and TV audiences. KBW Bank Index off 4.5% year-to-date, up 34% since October 27th. Then let's look at the regionals, obviously front and center this year. The KRE, it's off 6% year-to-date, but up almost 40% since October 25th. So it's been interesting to see the momentum here, like we've seen in so many different sectors, but especially in the financial sector. Of this list of names, so Bank of America's on it, Huntington Bank shares, Fifth Third, M&T Bank, Western Alliance. Is there a common theme? I mean, you've been talking about it a little bit. Common theme among these names that you think investors might want to suggest adding one of these to their portfolios?
One of the common themes is that the stocks are not terribly expensive. When you look at the valuations of the banks today and you compare them to historical levels, we're still not at or above historical valuation levels. And second, the other thing that we have to remember is that when you take a look at the book value and tangible book value per share numbers for all the banks, well, that includes the unrealized bond losses that they have in their available for sale portfolios. And as you know, with the bond yield falling from, close to 5% or at 5% in October to under 4%, those losses are going to drop, meaning book values and tangible book value growth is going to be faster, making the stocks even more attractive on a price to book or price to tangible book level when you adjust for these unrealized losses.
Well, Gerard, let's go from valuations to fundamentals, because when we think about sort of the business of banks, it feels like trading has been pretty good, but the deal-making side of things has obviously been pretty depressed this year and last year. Do you expect that dynamic to flip in 2024, or at least for deal-making to maybe see a little bit of a revival?
When you look at deal-making within the banking system, you're right, it's been very depressed, and the main culprit has been interest rates, because when you think about a buyer of a bank, another bank, they have to mark the book to market. So when you market to market, if you have a 3% or a 4% asset in a 7% or 6% yield market, you have to reduce the value of that asset. That has prevented deals from happening because the marks are too large. So if rates start to continue to fall in 24, plus as those assets pay off, the marks will diminish. And in 2025, we think we're going to really see a lot of activity. We're not very bullish on the big activity in 24. The other thing we have to keep in mind, we have regulatory changes coming under Basel III Endgame. So many of the banks want to wait until see the final proposals before they move. So the regulatory outlook is also uncertain, which is weighing on M&A activity within the banking industry.
And I'm sure we'll hear from the Don himself on regulation and Basel III. I'm talking about all, not just Jamie Dimon, but all the bank CEOs. But that's got a consequence, hasn't it, for the dividend and the payout scenario for US banks going into next year. So lay out that map for 2024 in terms of buybacks and dividends. Is it buyback dividend delayed but not denied?
Good question, Manus. I would say not on the dividends. Dividends are not going to be delayed in terms of increases. The banks have been increasing the dividends maybe not as much as they've done in recent years, and we expect that to continue. But you did put your finger on the delay on the buybacks. There have been delays in buybacks because banks really want to see what the new capital requirements will be. And until they really get their arms around it, they're going to be a little more cautious. We should have some final proposals, I think, floated by the summertime. So I think the buybacks could potentially kick in very strong in the second half of the year and certainly in 2025 because the banks all have sufficient capital to exceed the new guidelines. They just need to know what those are going to be.
Okay, Jared, thank you very much. Interesting that JPM isn't on your hot ticket list for the start of 2024. Let's see if that holds.
Jamie Dimon's calling, by the way. We're just going to tell you, Gerard. He's calling. He wants to talk to you.
You're in that danger zone with the ladies on this show. Okay, Jared, thank you very much. Coming up in the show, we are going to talk a little bit more about these markets, but I think we have crowned the phrase of the day, which is weaponized FOMO. Katie wants a red headline for a record high. We're 0.5% away from that. We're into the 9th week of gains. Can that extend is the question.
We'll find out soon. Of course, markets open in about 5 minutes officially. Of course, we've been on air since 6 a.m. watching those futures trade. But, you know, we did string together a pretty nice rally yesterday, 0.4% higher. We're only 0.5% away.
Continue moving up.
What did you two do to the oil market? I mean, given the no, on a more serious note,
I took a nap.
You took a nap. She likes to nap. We're beginning to find out a little bit more about one another. It's the first time they put us together,
so
we begin to learn.
Which meant you got a fair amount of sleep.
Crazy dreams.
Crazy dreams.
I hope we were in them.
Actually,
I hope I wasn't. Love you, but no.
No, not that much. Okay, well, Christina Hooper, we will catch up with her at Invesco in terms of whether she is filled with weaponized FOMO on markets. Good morning from New York. Welcome back to Surveillance, a special edition this morning alongside Carol Massar, Katie Greifeld, and myself, Manus, Cranny. We're moments away from the opening of the cash trading in markets. Fairly flat at the moment, down just 0.8%. There is the opening bell. Roll it over to cash. You can play with any number of superlatives. This is the hopeful extension into week 9 of a rally on the S&P 500. Just because everyone sees a bull market doesn't mean it's a top. That's according to Oppenheimer. Apple very much in focus. They're appealing their U.S. sales ban. We turn to green on the euro dollar, up 110.78. Bonds, you couldn't give them away at 5%, according to Steve Sosnick. This morning, 383. If they're not part of your portfolio, perhaps you have a severe case of weaponized FOMO. Crude drops by 0.8%, giving back some of the geopolitical angst that was in the price yesterday. At this stage, up by 2.8%. But to wrap up the market open and kick you off for your Wednesday trade, Abigail Doolittle is here with the movers. Good morning.
Good morning. And this might be a quiet, sleepy post-Christmas in between New Year's Day. But we do have something happening, which is sort of unusual for this sort of a day, which is Cytokinetics having its best day ever, absolutely soaring, up about 62%. This biopharmaceutical company, they have an experimental heart drug that helps patients with a genetic heart ailment. And in a late-stage trial, it's very successful. It spurred rumors of a potential takeover. And we have, of course, had some recent M&A activity pointing to a healthy backdrop for that possibility. The drug apparently improved exercise capacity and oxygen uptake versus placebo. There is a short squeeze here on that, now up 67%, considering the 14% short interest. Now, speaking of exercise, Lifetime. Now, this is a holding company for fitness centers, maybe also the equipment that Katie uses. There's also a high short interest here of nearly 9%. Those bears are winning just a little bit. CFO Robert Houghton is stepping down. It's not clear why. Eric Weaver, the senior VP and controller, will succeed and start on January 1st. And then Tesla, Wedbush, Dan Ives, constructive on delivery, their delivery trajectory for the fourth quarter, tracking slightly ahead of the nearly 500,000 delivery unit bogey. Some strong data apparently out of China, of all places, is giving Dan Ives some confidence. And what a difference a year makes. Last year at this time, the stock was absolutely plunging. Right now, up more than 100% on the year. And then finally, finally, let's take a look at Apple. I don't think that this stock is moving all that much, but of course we have this Apple smartwatch saga continuing. Now, they are trying to defend a roughly $17 billion business. They're appealing a U.S. sales ban of the smartwatches imposed by the U.S. International Trade Commission over a patent dispute with Massimo. I hope I'm saying that correctly.
That's how I've been saying it, so
okay,
go with
perfect.
it.
We'll go with it.
Phew.
The White House, of course, has failed to veto that ruling, so the company's trying to get it overturned in federal court, something to keep an eye on. But again, the stock not moving all that much.
I never thought that apples and wearables could be $17 billion of revenue, but it just shows you.
Or that's a small business, not as important
yes.
as $17 billion
Incremental.
worth, right?
Incremental. Of course, they're going to appeal to the federal court to remove the bar. Let's see, what does it mean for you out there with your watchables? With your wearable watchables. There you go. We just make it up as we go along.
What is
Snackables,
wearables, watchables.
Okay, I might gums.
Or squishables.
Squishables.
We'll park it there.
TBD.
9:33. Abigail, great to have you with us this morning. Setting the agenda on the market open. Apple is going to be pretty important. Christina Hooper is the chief market strategist at Invesco. Christina, good morning. Let's kick it off with tech. Will the Magnificent Seven be something that you've just got to absolutely own, whether it's reluctantly or not, and then broaden your church to perform well in 2024? Good morning.
Good morning. Great to be on. So I think that the key to 2024 is to be well diversified. We certainly saw strong performance from the Magnificent Seven, from areas of technology in 23. But I think the story for 2024 is about, at least in the first half of the year, expectations of a reacceleration in the back half of the year. And that suggests to me that we're likely to see smaller caps perform better. We're likely to see cyclicals perform better. So we certainly want to have exposure to technology. That's part of being well diversified. And I think there are arguments for why tech will actually be one of the better performing sectors. But I think it's really important to have that exposure to smaller caps and cyclicals because those really should benefit from a discounting of a recovery in the back half of the year.
Christina, I always wonder, when you guys look back or you look back at 2023, is there something that you had missed that you wish you had seen earlier in terms of trends, and that is kind of shaping how you're thinking about the investment environment in 2024?
Well, that was a much easier question to answer if starting out 23, because 2022, I think, surprised many in terms of just how quickly the Fed hiked rates and just the damage to major asset classes. Looking back at 23, I think that was an environment in which we expected to see something of a bumpy landing. It didn't come as quickly as we anticipated. And probably there are a lot of folks who expected some kind of landing in 23 that didn't see it. I'm still in the camp that anticipates a bumpy landing in 24 as opposed to a soft landing. I know that's not really the conventional wisdom today, but my view is that we saw so much aggressive tightening, and it was quite synchronized across major Western developed economies. So I don't think we're going to get away with a truly soft landing, but I do think we're going to see a bumpy type of landing in the first half of the year, but it'll be quite brief, and then we can get that out of the way and look towards a reacceleration in the back half.
I love that you went there. I wonder how much of that bumpy landing goes to something that we talked about what global central banks will be doing maybe differently. Maybe Europe has to ease earlier than the United States. So how does that kind of roll into your investment thesis?
Well, I don't think that there's going to be a lot of difference between the central banks in terms of when they start easing. I think the more important takeaway is that they are all going to be easing, and I think it's going to be rather significant this year, especially for the Fed. I'm in the camp of 100 to 150 basis points this year, not because I think the economy is going to deteriorate dramatically, but because Fed officials themselves have admitted that where monetary policy is today is very restrictive. And so if we see a continued disinflation, which I think we will, I think it's going to actually accelerate from here, I think the Fed is going to be forced to cut to just get out of very restrictive territory.
And so, Christina, if we do see all of these big developed market central banks kind of moving in tandem when it comes to the downside, of course, cutting rates in harmony, so to speak, how does that play out in global equity markets? Does that lead to another year where the U.S. is outperforming, or how does the rest of the world shake out?
Well, I think that what we're going to see is probably the Fed cut more than other major central banks. And so what we're likely to see is a continuation of US dollar weakening, and that should be positive for other areas of the world. In particular, what we're likely to see is areas like the European stock market benefit from more exposure to cyclicals, which I think are going to perform better, again, as markets discount a reacceleration. I also think there's a lot of opportunity, and I'm most positive on emerging markets, which I think will also benefit from an easing US dollar.
So, Manus, I did ask about the rest of the world.
You're okay.
I got it in
To
there.
be fair, now cyclicals are not going to save your life and give you a retirement fund.
Christina, we're getting a lot of flack from Manus this morning that we're too U.S.-centric.
Well, something else.
Then Jonathan Ferro would get on the phone and say, why are you talking about anything else apart from U.S. stocks, Manus? It's a U.S. stock market opening show. Focus on the U.S. stocks, which is fair enough.
I hope he's not watching.
No,
but,
he's walking somewhere very happy and healthy and away from here.
I would imagine so. But, Christina, coming to another debate that we've been having, if you want to call it that, money market funds. There is so much cash in money market funds right now, $6 trillion or so by some estimates. When does that cash come out, if at all? How sticky is that cash, and does it belong to risk assets, or can it stay there?
So I think the big question is, how overweight are investors in money markets? Some exposure makes sense. Let's face it, that's part of being well diversified. But there is a significant overweight on the part of some investors. And I do think that starts to come out. It's interesting because it could very well be something of a perfect storm this year, where we see rates start to go down. So money market looks less attractive as a broadening of the stock market looks more attractive. I also think an important destination for some of that excess money market assets is likely to be longer duration fixed income. In particular, I'm excited about investment grade bonds, but I also see opportunity.
In the U.S.?
Yes, in the U.S., to a lesser extent in Europe, but definitely in the U.S. And I'm also very excited about emerging market debt.
Well, let's just talk about the emerging market, because that's twice that you've mentioned it. If I look at the flow into ETFs in emerging markets, you're looking at $26.5 billion going into equity ETFs. Now, of course, Goldman Sachs have been their mea culpa moment. They said you want to strip out China from emerging markets. So do you strip out China from the emerging market call that you've just made? And do you want to be longer of equity than you are of debt within the EM trade?
No, I don't think you strip out China, although it probably makes sense because it's such a major economy and such a major investment destination to have it as a separate allocation. But when I'm talking about emerging markets, I'm including China in there. I think there's potential there, especially if we see a continued rollout of targeted policies that are stimulative, that address, for example, the property sector. But there's a lot of opportunity outside China as well, especially in Asia EM, that should benefit from an improving Chinese economy, but also have a lot of things in their favor. I mean, if we think about some of the Asia EM countries, demographic trends are really attractive, growing middle class. I mean, it's an interesting time. And also valuations look quite attractive.
Hey, Christina, I feel like we'd be remiss. Just 45 seconds. We're watching geopolitics. I'm thinking about politics in the U.S. later this year, the presidential election. Just very quickly, 30 seconds. How are you thinking about that?
Well, I think most investors have a long time horizon, and so they shouldn't let what's going on, the headlines, which can sometimes be concerning and disturbing, to take them away from a long-term investment plan that's well diversified. Yes, we're likely to see gyrations that are more short-term in nature, but for most with long time horizons, it's really all about being well diversified and putting on political blinders.
Okay. We got the blinders on, Christina. We are agnostic. Christina Hooper there at Invesco with her calls on the equity markets. And of course, that is in part tied to how much rate cuts you get. She's in the market for 100 to 150. Let's check the markets at the moment. S&P 500 still desperately trying to get a new record high, 47.77. Now turning into the green by 0.5%. So we have that little...
Desperate? Is it really desperate? It looks kind of limp there.
Well,
It feels tired.
depends where you are. No, you got to reinvigorate yourselves. I mean, you've got to actually get... You know, your job here is to make these things come alive.
And I'm saying it would be so excited if we were absolutely unchanged for the first time.
I believe you.
Since 2017.
I can see you're going to get it on your phone. It's going to be on your social feed.
I'm just waiting to tweet that out, man.
I think what is surprising is that oil is giving back nearly 1%.
Yeah, agreed.
As I've said to you, both of you, I'm very surprised that you don't have more of a war premium in there. In total, in the past 7 trading days, you're looking at a 5% rally, and 5% rally does not constitute any kind of war escalation premium, even though you have ignited more attacks in the Red Sea. You've got U.S. activity in Iraq. We've had EDNF man here this morning saying oil is cheap. And don't forget, the U.S. is refilling the SP ore at these kind of levels.
In a green world and climate change very much front and center, it just feels like we are awash when it comes to energy and hydrocarbons. Like, it just feels like that, you know, it's just kind of interesting to see some of these numbers.
Being awash in oil, not necessarily a great thing. But when it comes to the war premium, I mean, you think about when we peaked, at least for this year, really came right around at the end of September. Really, since we've seen the Israel-Hamas war break out, it's just been a leg lower for oil.
And that's where OPEC Plus, the Saudis in the first instance, along with the Russians, were, one could say, well, the phrase is preemptive, proactive, protective actions by the OPEC Plus members, and that's when they extended their unilateral cuts to the end of December. We then had an OPEC Plus meeting where they went further.
A lot of conversations going on. India's Prime Minister Modi talking to the Saudi Crown Prince after that oil vessel attack. There are a lot of conversations going on around the world because everybody's watching it.
And this is about the coalition of strength in the Red Sea to protect 12%. I think that's the number that you said, Carol. 12% of global trade going through the Red Sea. That is your risk this morning. Coming up with the team, Bill Northey of U.S. Bank Wealth Management joins us next.
Washington, D.C. has decided that they're going to run this U.S. economy at full employment at all cost, which means it's going to be very difficult to get the consumer to pull back. I do believe 2024 is going to be the year that we have a very serious discussion in the financial markets about the Federal Reserve's credibility as an independent entity.
That was Tom Tzorius, Strategas head of fixed income research on the credibility of the Federal Reserve going into 2024. It's going to be an election year. The market presumes 150 basis points. Do they front load those? This is going to be the slightly more interesting nuance. We've had various guests this morning saying they think the Fed will go first and be more aggressive in the front loading their rate cuts relative to the ECB, relative to the UK. The question is, of course, who's going to be bounced into that most aggressively and first, and that is the debate.
Well, especially when you have some guests coming on and saying, well, maybe it doesn't start till maybe June or July. You've got a meeting in both of those months. Is September 20th off the table because it's getting too close? November 1st, absolutely off the table. So how do you think about it?
Well, I'll steal a thought from Lisa Abramowitz. Last week, she made the point.
I believe it's the Queen, because she's like incredible.
The Queen of surveillance. Doesn't matter if they go in March or April or June. Does it really matter? Of course, I know that the market and all of us are really going to twist ourselves in knots trying to debate that. But at the end of the day,
it probably does. I mean, just think how we twisted ourselves up in knots over whether the nuance was pause to pivot. No, it's good morning, Lisa. I'm sure she's tuned in. No, she's probably on somewhere far away enjoying herself. On the slopes, enjoying herself. But, I think it is. I think we would become myopically obsessed with this again in the same way as we look at every nuance of every Fed speaker. What does it mean? What does it mean from the Hawks? What does it mean from the Doves in terms of the number of rate cuts that you're going to get?
It's also going to be, right, is it at 25, is it 50? Or, always the concern is, oh, wait, the Fed moved faster, or sooner rather than later. So that means, oh, wait, what are they seeing? Is the economy more problematic here in the United States than we all thought? Is it not maybe the softer landing? I mean, the conversations we're going to have where we kind of just pick apart and parse everything that they say, the Fed officials.
Well, the question is at 384 on 10-year government bond yields. By the way, we have a global bond market rally this morning. You've got German government bonds. You've got UK.
Wait, we have a global bond market rally?
There is a word. There is a word.
Other countries have bonds.
Okay, you two. Okay, this is the Jersey. This is the Jersey girls sort of building up and back backlash against a poor Irish guy that just got off the boat.
Oh, please.
You make a good point, though. The yields, they're moving lower.
They are moving lower.
And our guests have said it, right? It's cumulative in terms of what we are seeing from global central banks.
So the question that we'll put to our very first guest, which is Bill Northeast, Senior Investment Director at U.S. Bank Wealth Management, is: do you buy bonds? If so, what allocation do you make to them into 2024? 2024, in theory, will now build up. You can see the headlines. It'll be the year of the bond. It wasn't supposed to end that way. U.S. bonds delivered a 3% return. Can we extend that rally into 2024? Good morning.
Good morning, Manus. And you guys are having a lot of fun on set there this morning. So, capital markets clearly respond to a mosaic of factors, but the past 2 years have been dominated by the battle against inflation and interest rates and interest rate expectations. We expect 2024 will be very much the same as we move into a period of time where there's an expectation of a Fed pivot. We've paused. Expectations around rate cuts have now been pulled as early as March of this year. But there remains this differential between capital market expectations and what the Fed has communicated through their summary of economic projections. And it's really that differentiation. 75 basis points is communicated by the Fed, expectations from the markets leaning 150 basis points in rate cuts in total and starting in March that will determine really the path and momentum of broad capital markets as we move into next year. So, specifically as it relates to bonds, most people started 2023 looking at those very juicy cash rates in the front end of the U.S. Treasury curve and thinking, 4 to 5% by the end of the year was something that should populate portfolios. And as we close out 2023, you're looking at potential record close for the S&P 500. Broad diversified portfolios balanced between bonds and stocks have actually produced very, very substantial returns relative to the safe cash return.
All right. So that means, Bill, timing and magnitude do matter in terms of those interest rate cuts. Having said that, would you advise investors to kind of wait before shifting around in their portfolio because we're not quite sure about the timing and the magnitude?
Well, our expectation has been that we will actually experience this mythical soft landing as we move through the balance of 2023 and into 2024, expecting that the front half of 2024 will likely mark the slowest period of economic expansion here in the United States. But we have to acknowledge there's a lot of risks, and the risk of a technical recession is a non-zero probability as we move through the first half of next year. So against that backdrop, we recognize there's opportunities, expectations for corporate earnings growing next year, albeit estimates might be a bit high at this point, but continued expansion, and that leaves us in a fairly neutral allocation with respect to how we're positioning portfolios against investor long-term goals and investment policy statements. So meaning equal weight equities at the headline, equal weight fixed income at the headlines, and we'll look for that next fat pitch to make a tactical allocation away, depending on the evolution of data. And that data can come in the form of certainly monetary policy as it reacts to the progression of inflation.
What is a non-zero probability? I'm sorry, I love statistics, got really into it, but what is a non-zero probability?
Well, our base case is for a soft landing, meaning that we expect our U.S. Bank Economics Group is expecting that we'll have something north of 1% growth as we move through the first half of next year into the second half. But we have to acknowledge that there are a whole host of potential risk factors that exist. As you were moving through your prior segments, you noted some of the geopolitical instability that exists around the globe. We're moving into an election cycle here in the United States, and there's a significant amount of lagged effect of monetary policy that has yet to be digested by our own economy, and monetary policy impacts around the globe that are yet to be fully digested by global economic circumstances. And so we have to respect the fact that there is a probability, and whether we put 10% on that or 20% on that, that we might have some small degree of contraction in the front half of the year.
Okay, so it sounds like a tail risk. I think we can leave it at that. But let's go back to how you position a portfolio around that. You said that you're at a pretty neutral positioning right now. What would you need to see to notch that up to maybe your risk appetite is back to normal?
Well, some of that really depends on how we arrive at the next set of rate cuts that will really be the primary factor that drive capital markets next year. If it's purely a function of inflation remaining under control and the Federal Reserve able to move back to a neutral rate, that's probably sets up very well for risk assets, allows corporate earnings to grow, and it may not ultimately manifest in the full 150 basis points of rate cuts. If, on the other hand, they must go 150 basis points or more based on economic weakness, that probably sets up for a more challenging set of economic circumstances and corporate earnings environment that will impair fundamentals. So as we think about that in portfolio positioning, last year, or I guess currently this year, 2023, has been a very narrow leadership year, as we've talked about really through the course of this year. But as we
Bill, I'm curious to know, we're in the last minute of the show, and we're curious. We've been debating all week in terms of the money market funds, the residual funds that are there. What level of cash do you have, and are you prepared to draw down the cash and deliberately invest it ahead of the rate cuts in the first quarter?
From an asset allocation standpoint, we keep cash at a relatively low level, but we acknowledge that clients, whether that's institutions or individuals, are holding a very significant amount of cash. And we would recommend that people begin to deploy that cash into longer-term investment opportunities in a balanced portfolio. So equities, fixed income, real assets. We believe that full investment will serve investors well as they move into the next calendar year.
Bill, thank you so much. Succinct and to the point there. Bill Northey of US Bank Wealth Management. Deploy your cash ahead of those potential rate cuts that are coming down the pike in theory. And if it was this year that you were involved in these markets, you wanted retail tech really in your performance in the S&P 500. But tomorrow we've got a pretty important conversation coming up on Bloomberg Surveillance, 7:30 a.m. Cathie Wood, founder and CEO of ARK Investment. She'll join the Jersey Girls and myself. So what's going to be the top of the agenda there, do you think?
Her performance has been pretty incredible. Yeah. Haven't seen the flows to match it in China. What we've been talking about all morning.
China, Tesla, her thoughts on Fed. She's had some really strong thoughts for a long time. So there's so much we're going to cover.
Yeah, and if you want an EV, do you want a Tesla? Or do you just want an alternative? That's the question. Are you an evangelist of Tesla? We'll ask Cathie those questions tomorrow from the team here in New York. A very good morning.